too. Before then, you could see that home prices tracked household median income, just like this.
Median house price, median household income. If we were to truly spend a day, you know what I need next year? I've gotten like, over this year, even though my year's been, I've come across like 3 to 4 to 5 like Kino employees, like people that I would want to hold on to through as long as possible. They're very good people. Good as in like they're good at their work, not morally good, not Superman good. Okay. I feel like next year I need to get, researchers, so I can ask questions and just have people go out and get the answers. That gunk guy in chat, by the way, is one of them. What a fucking rock star this guy is. Holy shit. 6'5" Giga Chad from the Midwest, who's also responsible for like all of the merch stuff and everything too. There are so many questions, and I'm not trying to, like, obviously you can ask questions in such a way that you're always trying to get the answer that you want, but I legitimately am curious. I hope at this point, even though it's never the case, but I have enough credibility that like I'll shift positions on things because I'm not like on some orthodoxically bought in, that's not a real word, like bought into some, take on any particular thing. But I do think a lot of the housing stuff is spoken about incorrectly, is over-exaggerated or whatever else. But when it comes to numbers like this, median household income versus median house price, I'm trying to think if I would expect these two things to track or not. I think you would, right? It goes all the way back to 1960. Median household income. Median. One of the, they kind of do with the scale is weird. Maybe. One of the things that is hard to imagine when you start to become, I don't think I would consider myself ultra wealthy yet, but I don't know if I would say I'm in the tier below, like very wealthy. This is one of the things I try to stress to people when you talk about like taxes, is the amount of money that you can spend on things that you need to live. It's only so much, right? So if I put, let's say that I earn $100,000 annually right here, okay? I'll just bracket this off. This can be whatever amount of time. Say this is my whole career, okay? Let's say that I earn 100,000 right here, all right? And then let's say that over time, my income has increased. And then let's say like right here, okay? I might have grossed, fuck, I don't remember my after-tax earnings rate. It was like $2 million last year. It was a good chunk of change. If I'm earning 100K here, and let's say that it was 2 million here, okay? And I understand that my life is not like everybody's because I don't fucking do anything with my money, but there's only so much that you can spend on housing. So for 100,000 a year, I could get a mortgage and I could spend maybe, let's say I get $4,000 a month would be, that'd be half my money, half my income. Well, 3,000 a month would be 36. It'd be okay. Let's assume this is all after tax. I could spend $3,000 a month, and that would give me a, let's see, mortgage calculator. Hold on. I want to put numbers to this because my guess is I could get a $500,000 house. We'll say 500,000. We'll just say 10% down. Back then it was, we'll say 4.5. I don't know what the average tax is. PMI is only for FHA loans, right? We'll say conventional. This, I don't need any of this bullshit. Okay, so this would be a monthly payment of $2,600, $500, $2,655, $2,700 a month, about, okay? Let's assume that, okay? So if I'm making $100,000, I could get pretty comfortably, I would say, a $500,000 home, okay? Let's say that I've 20x'd my income, all right? And let's say we go from 100,000 to 2 million. Well, a $500,000 home to a $5 million home, that's a massive increase in home, okay? You are massively increasing the type of house that you get from 500K to 5 million. That's like, I would say almost mansion tier, okay? Let's assume that we do that. I would never get a house that big. We'll hold all the other values the same. So I'll say 10% down payment. We'll say $5 million home, okay? And then we calculate this. A $5 million home is going to cost me maybe $23,000 a month, all right? So I've 20x'd my income. My mortgage payment isn't even 10x'd. And I've got more house that I know what to do with. So what happens is even if you upgrade your standard of living, like if we assume that this much of my income is paid on my, we'll just say housing expenses, even if I dramatically increase the type of house I get, it's still not even coming close to like, it's so much money. You just have so much more money. This is why I say things like, even if you're talking about higher tax rates, right? Like if you were to, let's say that we're eating this much with taxes or whatever, like right here, if you were to scrape away another like 2% on really high income earners of like taxes. Now, I'm not a fan of just taxing high earners. You have to broaden your tax base. It can't just be because the people at the top can't front the entire country, but you can increase tax rates for all these people. And they're not going to, I don't believe they'll feel it. I just don't believe that. Okay. If you have an expendable income of, in my opinion, again, this is pegged in my lifestyle, I guess, because I just don't buy much. Maybe for Hassan it's different. But once you're earning more, once you have more than 100,000 a month of like play money, I don't know what you do with it besides throw it in investment accounts. And if somebody were to say like you had 100,000 a month in play money, but now because of these new taxes, now you only have 85,000 a month in play money. It's like, okay, like am I fleeing the country over this? I'm not even going to move my state for that. Like what? Okay. So I feel like there's room in here to tax people. Why am I bringing this up? Oh, I'm bringing this up just because sometimes I don't know all the time how I would expect to see household income and house prices, if I would expect to see these things track each other equivalently. Or if I would expect to see, that's what I'm saying. I don't know if I would expect to see the relationship be parallel. But I would have to think a lot more about how I would expect the numbers to play out. I'm just not 100% sure. Yeah. Also, there's also another thing. Somebody brought this up in chat, and I don't know how this is ever factored in. But I feel like when people look at housing prices, I'm also curious, what were your average monthly payments compared to your median household income, rather than just house price? Or can you do an average interest adjusted housing price to median household income? And I only say that because I could just look at federal funds rates, right? With that, I remember when we left the gold standard, all that bullshit. When I look here, so in 1970, 1980, wow, it looked like the median housing prices were tracking the median household income way better than they were now. But when I go back to 1980, bruh, my 30-year fixed mortgage was 13% or 16%. Like, that's an unheard of it. Nobody would even believe you. Nobody would believe you told them today you got a car loan at more than 10%. Like, what? You have a car note for 12%? Are you crazy about the 12%? So I'm curious how these housing prices factor in the interest rates as well. Mortgage calculator. Let me just do another thing, because I don't know if people are aware sometimes of the interest rate. Like a few points will go crazy, crazy, crazy. Wait, hold on. 1 second. Okay. Let's assume a $500,000 house. We'll say 10% down. Oh, it doesn't really matter. $500,000 house, 10% down. So the difference between an interest rate of 6% and 12%, that's like a comically high interest rate. Even 6% sounds high to me, but that's probably more normal now. At 6%, $500,000 home, you're looking at $3,260 a month for factoring in PMI, something mortgage insurance, something. I thought that was only on FHA loans. I don't know, but whatever. It's when the loan amount is a high enough percentage of the equity in the house or some bullshit to insure the bank. Okay, but anyway, so $3,260 if you have a 30-year loan, that's at 6%. At 12%, your monthly payments are $5,200. Is a significant increase in monthly cost. Now, when you're talking about your ratio of income to housing payment, you're talking about your monthly payments, not the overall cost of the loan or interest or whatever else. So all that to say that at 12 percentage points, right, our monthly payment is $5,200. If the interest rate was half that, 6%, how much more house could we get? Let's try a $1 million house. Calculate. Okay, not quite that high. Hold on. Let's try a $800,000 house. Is that right? 1, 2, 3. Calculate. Let's try if I wasn't being lazy, we could just break out the calculator. $820,000 house. No. $40,000. Okay. So if you could finance something at 6%, you could buy an $840,000 home and your monthly payments would be about the same as a $500,000 home at 12% interest. So if you were doing like the chart on this and you were to say 10 years later, let's say that right now you could buy a home for $500,000 at 12% interest, okay? And then let's say 10 years later, that same home is now worth $750,000 or something, right? You know, the guy who bought the house before is like, look at me, I made a great investment in my housing. You got completely fucked because now, you know, you waited 10 years and now my housing has improved by $500,000 to $750,000. I made $250,000. But the reality is if you buy that 700, and you might even feel like you're getting fucked. Fuck, this same house, you know, a decade ago was, or 5 years ago, or however long it would take for the interest rate to adjust. Maybe we'll say 5 years, or whatever, right? 5 years ago, you know, this house was only $500,000. Now it's $750,000. I'm fucked. I got fucked so hard. And it's like, well, if you buy that $750,000 house right now, your payments are actually going to be lower because the interest rate is so much lower. And this guy is going to be bleeding off so much more money to paying interest. By the end of your $750,000 loan on this guy, he's paid $782,000 in just interest payments, right? This other guy who got it for only $500,000 earlier, right? This guy's paid $1.2 million in interest. I'm not trying to say that like one thing is necessarily better or worse. I'm just saying that I don't know why I never see these charts ever factor in interest rates when interest rates historically have been so substantially different. Like, I don't care what you paid. Like, I don't know if people, I just don't know who's like been in the market for loans for cars or homes. This is not real. I don't believe that anybody paid these interest rates. Motherfuckers financing a house at 15%, 16%. There's no way. That's crazy. That's just crazy to me. So when somebody says like, well, if you look at the chart in 1970, 1980, the median house price was much lower. It's like, sure, but what were your monthly payments? Because they're financing these things at crazy interest rates. Isn't this broken a bit because people can refinance but keep the original house purchase price? Yes, Refinancing is an option, although one, you're going to have to pay closing costs on the loan again. I believe that's generally the case, which I think is 2.5 points usually. Somebody can correct me around that. So that means that if you bought a new house for $1 million and you put $100,000 down or $200,000 down, so you have an $800,000 loan. If interest rates drop dramatically in 3 years and you still have about an $800,000 loan and you want to refinance that loan, well, you're going to have to pay about $20,000 in closing costs that's going to be rolled into the new loan to refinance. Now, depending on your credit and everything else, like refinancing can be worth it. This is assuming your credit doesn't go down or anything in the meantime. Like refinancing can be worth it for sure. But you have to be careful because you're going to have more. You're going to have to pay closing costs again. You're going to have to hope that the housing market didn't go down or crash at all, because if it goes down, you can't refinance. You're locked in because you'd be upside down on the loan. But refinancing is a thing because a lot of people refinanced here in the COVID era. Right now, today, I believe the highest percentage of Americans have the lowest interest rates loans than have ever been had in the history of all the housing market. Another thing that people don't talk about much because they're largely invisible for some reason, at least on Twitter, is most people are doing really, really well on housing. They just don't talk about it. But I think the reason why they don't talk about it is because fuck, I'm not gonna be able to find this chart on this site, am I? There's always like a graph on Twitter that gets posted for some guy that wrote an article on this. But the reason why is because when people are doing good on their homes, meaning they are financed at a favorable rate and they're gaining a ton of equity, is you don't see that, right? That's an invisible, like, oh, cool. Like, what's your house worth? Well, now it's up to $1.5 million. Wow. What do you own it? Only $200K. Wow. You have 1.3 million in equity and you're gaining more equity. Yeah. What do you have for that? Nothing. You have nothing. You don't have anything to show for it. It's just more equity in your home. It's like, oh, well, fuck me, But then as housing costs go up, the people that are helped the most by housing increasing, and those people are out there and they're numerous. They outnumber the other people and they're making a lot of money, but that money they're making is largely invisible because it's hidden in the equity of their home. But the people that are hurt by housing costs increasing are incredibly visible because now they can't afford a place, right? So on one end, you've got 10 people that are all gaining equity in their home that are very happy about that equity, but they're not super public about the happiness because they don't even really see that happiness. Then you've got 2 people that are trying to move to a new place. Well, the 2 people can't afford any place. It's like, what the fuck? This shit is all fucked. The 2 people are going to complain. They should, right? They can't afford to move into a place. Like, fuck me. And the 10 people who are like, yeah, that sure is fucked, bro. Not realizing that the reason why the prices are so high is because they're the ones benefiting from it, It's a really fucked, it's a difficult situation. Yeah. Fuck it. I'm going to say it. I don't know what equity is. So equity is when the fence is the right height for everybody, as opposed to everybody getting the same box. Your net worth is a combination of assets and liabilities, and it's the difference between those two functions. So let's say that I am let's say that I'm a human being, and let's say that if I look at my balance sheet for my life, I have a $1 million house and I have a $100,000 car. That's worth right now $1 million and $100,000, right? We'll say that. Well, let's just look at a house, okay? Actually, we're just gonna talk about a house, okay? So let's say this is 1 million. I'm the worst drawer ever. This looks like SHM. Let's try this again. 1 million. There you go. Let's say that I buy a house at $1 million. Let's say that this house steadily grows in value over time, okay? When I buy this house right at the beginning, now we'll say we make about a 10% down payment. When I buy this house right at the beginning, I have a loan on it, and that loan is going to be for $900,000, right? My equity in this is going to be the difference between the asset value, so the asset is valued at $1 million, and any outstanding liabilities related to that asset. So my mortgage, right? So I owe $900,000 on it. I have the asset that is worth $1 million. So the equity that I have is the difference between these two values. The equity I have is about $100,000. As time goes on, and hopefully you pay your mortgage down. What are these? These curves end up looking like this usually. Something like this. It's going to be more dramatic. As time goes on, you can see that I have more equity, right? My equity is the difference between what I owe and what the asset is worth, right? You can see there are a few situations where, well, what is equity, right? Equity is asset value. There's some value here. When people talk about getting, you might have heard the term like HELOC, home equity line of credit, right? Sometimes people like to access this equity here. And what they can do is they can go to the bank and say, hey, I want to take out a loan and I want that loan to be secured by the equity in my home. Meaning, I mean, technically you could take my house. Could somebody seize your house for defaulting on a HELOC? I don't think it's seize your house, but they'd find some way to garnish your shit. But yeah, ultimately it would be backed up by this asset. That's why home equity line of credit should be lower interest rate than an ordinary credit card unsecured, right? So I could take out like a HELOC here, right? So, and then I could pay this down over time, but as I borrow against it, right, what's happening? You can see, well, normally I have this much equity, but if I take out a HELOC, well, now I only have this much equity. I'm reducing the equity in my home because I'm borrowing against the value of it here with a HELOC. You can also see that like, if these things become too detached from each other, like if I'm gaining asset value really, really, really fast, you can also see some of the toxic incentives that fed into everybody's behavior for the housing market crash, right? For instance, let's say that I actually can't really afford the monthly payments in a responsible manner on a really, really, really expensive house. But let's say that the housing prices were increasing really fast, right? I might get a really, really favorable loan here with almost 0% down, and I might not really be able to even make the payments at all. Maybe I don't want to say default, but I start missing payments and it goes up. But if the asset value is increasing fast enough, I could just say, fuck it and sell the house. Or I could take out a loan against the equity in the home that I have now to pay down this balance. And as long as this value is going up fast enough, technically I'm okay, right? This is some of and you're even financially incentivized. Technically, it's a good thing to do this from a financial point of view. You should, right? You really should do this financially because of another concept called leverage. But that's another thing. But you all know what leverage is, and you all understand this. You don't have to explain that, right? But then you can see the other issue of when you have like a property value. Let's assume that something happens. Wait, Dustin, you'd be okay with the equity because the equity would be increasing with the housing value and cost? Yes, your equity is going up. As long as your equity is increasing, everything is technically okay, right? Let's say that you went into an issue where you have a home and you're making payments on it. But let's say that for some reason there's like a housing market collapse. Sometimes what will happen is you owe more money outstanding on the home here, right? So this represents equity. Look, we have equity in our home. We have the asset value is greater than the total cost of the debt or the cost of the loan, I shouldn't say cost of the loan, the total loan amount on the house. Okay, that's cool. But when we get to this area here, we owe more on the house than the house is worth. Now, technically, if you're just like making your monthly payments and you're living life or whatever, it doesn't matter if you're upside down. I mean, I guess it feels bad emotionally, but it doesn't really hurt you to do anything. But you can't refinance, right? If you were to go to the bank and you were to say, hey, I would like to redo the loan on my home, like at this point here, for instance, the bank would say, well, hold on. Your home right now is worth $200,000 and you owe $400,000 on your home. We're not going to refinance. It's basically an unsecured debt at this point. If you defaulted on your loan at $400K, then you're in a negative equity situation. So the bank's like a loser here, right? One of the reasons why home loans are so cheap, the interest rates are so low, they're so close to the federal funds rate. The prime lending is close to the federal funds rate, which is what the Federal Reserve makes money available to the banks or whatever bullshit do, right? One of the reasons why banks do these loans so favorably is because you have equity in the home. If you default, the bank takes your asset, and now the bank has the equity, right? If somebody has their home at this point and they default right here, let's say they default, they start missing too many payments, they don't make a plan to catch up, and it's over. The bank says, well, we're going to take your asset. Now the bank has captured this equity. Now technically you're going to get retards who say, oh, the banks like to repo your house. But it's more worth, banks don't want to be in the business of selling homes. It's just not, they don't care about that. They'll give you a loan for a home, but that's not the same as that. Bank doesn't really want to do this. They'll make plans with you to pay this and they don't really want to take it. But if they have to, they can, but it's okay because this is what a secured loan is, right? You have, you have equity to back up your note, your mortgage. But in this case, the bank really doesn't want to repo your home because you're upside down on your mortgage and now the bank has to come and take your home. Well, the bank is literally out money because, you might have owed $400,000 up here on your mortgage. The home isn't even worth $400,000 anymore. Now the bank is super fucked. So definitely won't refinance here. Okay, sorry. Random shit. Okay. Now explain why Tom Selleck wants me to do a double mortgage. I don't even know what the fuck a double mortgage is. Humans are funny because what the fuck is this shit? You say that, but left to your own devices with you and a bunch of friends, you would all come up with these systems yourselves. And stuff like this would even like naturally emerge too in humans. Like these kinds of economies and these kinds of deals and these kinds of things just naturally emerge. Okay, so the equity is not completely tied to the home value, but it's tied to the loan amount used to buy the home. Equity is just how much of a thing you own. So if I have 100% equity, that means that I own the asset and there are no outstanding debt obligations or anything related to the asset. That's the percentage equity. The absolute value in equity is just the difference, the number difference between the asset value and the outstanding liabilities against that value. So if I have $1 million home and I owe $500,000 on it, then I would say I have 50% equity in the house. If I, or in an absolute term, I'd say $500,000 of equity, right? Are there any 5 books you would recommend? The first 5 Harry Potter books. Got 'em. Whoa! Sorry. Metalloid. Okay, I think your problem here is you make assumption based on a good ground of thoughts. You're right about most people doing well for housing and ownership for young people, but loud people are always going to be the people who aren't benefiting. Young people are in the data. It is in the data before you say it getting worse every year on chance of getting a house since 2020. This is an unemployment wage, et cetera. Not to mention everyone is worse off since the 1900s. It wouldn't surprise me if young people were worse off. I think that there's probably some genuine stuff that's bad that we need to work on, and then there's other stuff that's not necessarily bad. I think about the in Chernobyl. Do you remember when he's doing the chart and showing how they keep the reaction balanced? There are some things that's probably going to push the average home ownership age for the first-time home buyer. That's important. First-time home buyer age is probably going to be pushed up. But there are things that apply pressure to that are probably good, that we would say are good things, and there are things that might apply pressure that we might say are bad things. So for instance, today, my guess is going to be more and more people, as time have gone on, are getting college degrees. The more people that go for college degrees, the higher the pressure is going to be on your first-time home buyer age, right? I would consider this a good pressure. If you don't go to college, like I think I bought my first house at 19 or 20, 4066 Hillsdale Avenue. I don't know if Zillow has the thing because I basically was working full time and I ended up quitting college. Fuck me. But because I focused on work instead of college, I could buy a home earlier. But I would argue that if you focus on college instead of work, then you're setting yourself up for better long-term success, right? So I would say we have upward pressure from going to college on first-time home buyer stuff. I would consider this fine. If it was later in life that people were buying homes because they were going to school, then this is okay. Another upward pressure might be, oh man, a lot of these things are hard to disaggregate. Another thing might be a lack of relationships. I don't know if I've ever, well, maybe recently, but in my working life, this is also why I shit on you guys for your housing takes. The idea of living alone was unheard of to me. That's like, you had to be on some wealthy shit. You always had to have a roommate. So if you don't have a girlfriend and you don't have a friend that you want to be a roommate with, that's also, I would imagine, putting off, this is for, we're talking about home buying though. Well, but even for home buying, it's just have a girlfriend who you shouldn't buy, you shouldn't buy a house with your first girlfriend unless you guys have been dating for a long time. But if you don't have good friendships, you don't have good relationships, the fact like moving out, this implies to more renting than home owning, but like that's going to put off your moving out from your parents or renting your first home or whatever. I guess actually lower romantic engagements also puts off marriage, which will also put off your first joint home buying. This is bad. So this would put upward pressure on, I shouldn't say upward pressure, this would push up the average age of the first time home buyer in a negative way, right? If people are saying, well, I can't afford a home because I don't have a life partner because I don't know how to meet anybody, that's not good. That would be an up thing. You have a weird interaction here. This is like the mythical ghost thing I don't think I've ever heard anybody talk about ever, which is like cost of housing. The cost of housing going up is both good and bad. It's bad because it'll push that first time home buyer age up, which just sucks. That's just a strict negative for people that are trying to buy houses. So younger people are just hurt by that, just purely hurt by that. But the people that own homes are benefiting from that. So that sucks. If you are trying to buy a home, it's good if you have homes. I would say that one thing that I would like to see changed, I don't know if this is possible, and I don't know how much impact this would have on the housing market. Sometimes you'll see this stat given where it will say the average cost of the average age of a person who buys a home today is like 48 years old. That number is misleading, but it's still important. There's a reason why earlier I said the average age of the first time home buyer. And the reason why I'm making that distinction is because old people like to collect houses. I feel like there should be either a significantly greater subsidy or something, benefit to people buying a primary residence versus people who are buying their second or third or fourth residence. The reason why the average age, somebody find this on the St. Louis Reserve fucking site, the average age of a home buyer is going up so much is because old people are buying multiple homes. Now your average first time home buyer age is still increasing. That's still going up. Not as dramatically as some people say, but it's still going up. But these motherfuckers, the thing is that when people have a house, they just don't really like to sell it. If they have it, it feels like, oh, I don't have to set money on fire and I just have a blah, blah, and they'll rent it out instead. Destiny, that's not true. What did I just say that's not true? This is average, not median age, but in the New York Fed finds the first time homebuyers are younger, 2024 than the 2000s. Average age at time. Oh, well, no, wait, this is showing what I'm saying, sorry. So like your first time home buyer age is here, and then your repeat buyer age is here. Repeat buyers, sometimes people will average these two and give you just the average age of a home buyer. This number, 38 years old, this seems way higher than any number I've ever seen before, though. I don't know where this guy is getting his data from, but I thought that 33 or 30. This is just average, so it's pulled up. I would need to see where this is coming from. I don't believe that the average first-time home buyer in the year 2000 was 38 years old. I don't believe that. That's way too high. 38? No. Maybe it's New York specific. This says New York Fed Consumer Credit Panel, so I don't think this is New York specific, is it? What is this? Liberty Street Economics. Who is still on first? An update on the characters first time home buyers. Wait, I feel like I've seen different numbers my whole life. Intuitively, I just don't believe this. There's no shot. Was it 38 years old? Was your average age for a first-time buyer in the year 2000? 38? I would vibe. Yeah, my vibes on that would be like 30 to, would be around 30. I don't know. That would be my vibes on that. I'm vibing that hard. Yeah, and I feel like I've seen other numbers that usually put it from 25 to 35, depending on how. Yeah, this is the chart that I've seen. This is why I felt like that was high. This is the one that I've seen before. People like to post this one a lot because, oh, they've added 1 year here. And they'll say that like, oh, that because somebody in my subreddit, I might have permabanned the fucking retard in this. Somebody in my subreddit was like, in 1992, the average age was only 28. And in 2021, it had gone all the way up to 38 or whatever, 36. And you can see how much it's gone. It's like, okay, hold on. You picked the lowest year here, and then you picked the highest year. I could just say like in 1989, it was 30. And then in 2020, it was 33. So it actually hasn't gone all that much at all. But that, yeah, the recent like 5 years have been very weird. Since COVID and everything for housing too. But this looks, yeah, I'm curious what the difference is. Chartrealtor.com, source National Association of Realtors. This on a vibe level, this tracks closer here. I'm thinking of like, I'm trying to think like, could my intuitions be off for some reason? So then I'm thinking like, well, maybe in really poor areas, maybe it's different. But no, it wouldn't track that because in poor areas, all the housing is shit too. And you just poor people buy smaller houses. Maybe in rich areas, maybe it's a lot different. I would be very curious to see the data set this is coming from. 38 years old seems very high to me for the average age at time of home purchase. Median age, not average. I'm tired, boss. I actually don't know if median is more appropriate here than average. Average might actually be more appropriate. Generally, you stay away from averages because extremes in your data set can dramatically skew the chart that you're looking at. But in terms of age, I don't know if that would happen. It's not like you're going to have a 1,000-year-old vampire buying a home that you need to use a median for to avoid the vampires. And I doubt there are baby geniuses at age 1 buying up a ton of homes in certain families. So average might be a fine metric to use for age as opposed to median for age. Destiny, they start at 2 different decades. Okay. This one still says in 2000, they put it at 38 years old. This one at 2000 puts it at 32. That's a pretty big difference. Destiny, you don't know stats, but okay. Feels greater than facts here. Explain why I'm wrong. Explain why what I just said is wrong. Is he considered one as a red line? True. Okay, doesn't elaborate. Based. True. Okay, sorry. Anyway, now that we've gone on that journey. Destiny, there wouldn't be any waiting from 0 to 18 to pull the data into an accurate average age, whereas there's going to be more outliers in the higher ranges. Median probably would correct for it. Oh. That's a good argument. Especially because, let me try to think if this makes sense. Especially because we're really looking for the beginning of a data set, like the lowest values. Are we? Hold on, I'm trying to think. If I had a bunch of people who were age 30 buying a home for the first time, and then a few people who were age 45, and they were dragging that average age up a little bit, would I want that shown in my data, or would I want a median value instead? No, actually, I'm not sure. No, I think that's fine. I don't think I need the 0 to 18 to pull it down at all. I would want it pulled up. But see figure 1 to see the issues with this bullshit. Stop. This is a Hutch tier video review. First time homebuyer crisis, fact or fiction? This NAR data, I think, is what the that one chart was that we looked at, because the data goes crazy from like 2020 to 2025, right? Yeah, this here. NAR estimate of median age of first-time homebuyers diverges from AHS estimate after 2021. Oh, he said begs the question instead of raises the question. Which median age estimate is closer to the truth? Did the median first time homebuyer increase dramatically, or did it stay not the same? It's difficult to know for sure, but we can compare these results. From 2018 to 2024, the age breakdown of first-time homebuyers has barely changed. Percentage of first-time homebuyers in each age bracket. Okay. Under 25 is going up a bit. 25 to 34 has been about the same. This has been about the same. Okay. The data are mostly unchanging over the period, while the share of first-time homebuyers between the age of 25 and 30 shrank by 1.2 percentage points over the period. The share of those under 25 increased by 1.4 percentage points. And every year between 2018 and 24, the majority of first-time homebuyers has been 34. Okay. In every year between 2018 and 2024, the majority of first-time homebuyers have been 34 or younger. Majority. Shouldn't this say has? Doesn't this verb need to agree with majority? In every year between 2018 and 2024, the majority have been, or is it the majority has been? Isn't majority treated as like a single, like, no, it's a plural. The people have been versus the people has been. The people have been. The majority have been. No, it's majority have. The majority party has. Why is that different? I don't know. Sorry, forget this. Okay. 34 or younger. Okay. Okay. Anyway, Jesus. Fuck. Fuck all this. Wait, where did my video go? Destiny, median better, mean will screw, higher age. There are more possibilities for outliers to shoot above average, and outliers can pull the average up more than they can pull it down. Wouldn't we want to see that expressed, though? If average was increasing quite a bit, wouldn't that point to the fact that really old people or older and older people are But I don't know. Okay. Jesus. Good job, guys. All right. We're 2 minutes into this video. Nice.
barely any movement.
Okay.
And then as women started joining the workforce, you also had divorce rates going up. And so you kind of had
Wait, I found the most optimal and quickest way to gain credit score if your chat carries from 600 to 900 in 2 years with just a credit card. Doomhauer and Stream Disagreements. I'm sorry, I'm curious. What?
Hello?
Yeah, what do you got for us, dude?
Alright, so you can legitimately get like 600 and 900 in like 2 years. I tested it with like me and 3 other friends, so it's pretty foolproof, I'd say. All it has to do with, and you can use the credit card like you would a normal credit card. You don't have to do anything special. All it is about timing when you do your payment and when the payment comes in. Like say it's like the first of the month, you know your thing gets checked for how much you owe on your credit card, right?
Okay.
And what you want to do is make sure you start out at always 30%. So most people like start out with only $1,000 on their card. That's like what most people get. Usually don't get any higher than that. What you want to do is your very first time, make sure as soon as like the first of the month hits, you only owe 300 on it. And then when the next month comes, do 290 and so on and so forth. So go 290, 280, and then go all the way down to $10. So each month it goes down by 1%, right? So every month the credit check sees that your usage is going down by 1%, and for some reason, it like, I don't know. I use Borrowwell and it increases your credit score exponentially as soon as it sees it go down, and then as soon as you get down to $10, restart it and go up to the 300, and
Wait,
you'll take
what
a big
is-
credit hit.
What is Borrowwell?
Borrowwell is just like a free thing that lets you check your credit score without like taking a hit on it.
Oh,
Yeah, it's
Okay.
just like,
okay.
yeah, so always just bring down your credit usage 1% each month and then reset it to $300 or whatever 30% is,
Mhm.
and you'll take a big credit hit. You lose like 20 or 30 points, but you're gaining like 20 or 30 points each month that your credit score goes down. And you repeat that on like 1 or 2 credit cards, and you just do that for 2 years, and you just get free credit score if you care about credit score, which I don't think a lot of people do now because you can't do much with it because most people use it for a home, right? And most people obviously can't afford homes now, but if you do it with that, basically my credit cards now are like $50,000 a month, and I don't make anywhere near on paper to like deserve that. So I don't, probably eventually I'll just
Wait, your credit cards are
max
what?
out. I have them up to like 50K each a month. I have 2 of them.
You
And I
mean
have like
like
a
that's
50K
your
limit on them.
that's your limit or that's your balance?
I that's my limit. I can use
Okay.
50K a month on
Alright.
each. And it started out at like $1,000. So if people want to like debt max, just do that, and then take out like 100K on the credit card, then never pay it back if you're a debt maxer. Because
All right.
if you want to do that, I mean, I don't recommend it, but if I know people like to do that and just not pay it back and then change their phone number, but it's kind of like a Sam Hyde retard method. But
Okay, cool. Well, thanks for the advice, buddy. Okay. I don't know why I don't sign off or condone on any of that. Okay.
something driving barely any movement.
Okay.
And then as women started joining the workforce, you also had divorce rates going up. And so you kind of had something driving household formation that you really hadn't had before, like families splitting up. Then comes the 80s when they start doing these securitizations where if you've watched The Big Short, and if anybody has not
I feel like that was just given without an explanation. Is she implying that when families were splitting up, the men and women were both just buying separate homes? My feeling would be that one would go back to live with their parents most likely, but that was an interesting thing to just kind of hang out there. But okay.
like families splitting up. Then comes the 80s when they start doing these securitizations where if you've watched The Big Short, and if anybody has not seen that movie, they really need to see it, but they package up the mortgages, they sell those bonds off. And this really drove a different kind of sort of activity in the mortgage market. It became about, a big part of it, even back in the 80s, was about investment. And so from there, what happens is you start seeing kind of this low interest rate, sort of every time we got into trouble, right? We would see these lower interest rates, and even the Fed would start buying mortgage-backed securities. That happened after the GFC. But
Well, in the 80s? Am I looking at the wrong chart? Am I retarded? Or was there some other number that I'm missing? Or... I mean, this is the 80s. These were lower when our low interest rate of only, in 1987, 9%. Not sure if that's what you're asking for. Scroll for a chart showing typical monthly mortgage payment 1971 to 2024.
The federal agencies reported $236 billion in improper.
Oh, Tom. Okay, sorry. Another video. Oh, is this adjusted for inflation? So this would show that the highest monthly mortgage rate was in 1981 but also, how do you adjust? Oh, fuck, this is too complicated for me. I was gonna say, like, how do you adjust for inflation, your mortgage payment, when housing is isn't housing a pretty big component of how you calculate inflation? I don't know. I'm sure they figured it out somehow.
even back in the 80s,
Melody Wright, she talks about it here briefly. Did you just link me the video that we're watching? Stop.
but even before then, you basically saw that whoever was in power would use the housing market to restart the economy after a cycle had ended, trying to get every Tom, Dick, and Harry into the housing market.
Right. So,
and then go ahead.
I just want to make sure I want to restate to make sure I understand. So every time we got into any economic turmoil, the government would cut interest rates, stimulate, even go as far as,
When did the I should know this because all the fucking crackpot conspiracies. I need to learn all these talking points better. Fuck, did we leave the gold standard in the 70s? Was it Nixon or whatever? Gold standard, United States. '71. How the Federal Reserve is an independent thing. How can when she says the government was raising and lowering interest rates, what does she mean by that? I don't know what that means.
The economic turmoil, the government would cut interest rates, stimulate, even go as far as, buy.
The government can't, unless the Federal Reserve was not independent at that point, and I'm just not aware of that. That's not possible. The government, for good reason, Congress does not have direct control over interest rates. So I don't know what she means when she says that.
Mortgage-backed securities, printing money. That led to the increasing housing prices.
Absolutely.
Okay.
Unless she's just saying that, like, the Federal Reserve, in trying to hit their economic indicators, was increasing or decreasing interest rates, unless she means that, maybe.
Absolutely. And, in the early 2000s, it truly was, I think, a lot of families that were buying. It worked to some degree, before the GFC. Well, then we get, but at the same time, you also had investors participating, buying up second homes, for either vacation or to do long-term rental. And, that's kind of a good way to make passive income. So we hit, 2000.
I don't believe this person. I feel like she's hit like 6 different meme talking points that are just not really, okay, this is retarded. Fuck. Okay, Metalloid is crazy in chat sometimes. I think this is just wait, who is this person? Maybe I should ask who this person is first. Maybe they're way overqualified and I'm retarded. Who is this person? Strategist, writer, technologist. GFC 1 survivor? Is that global financial crisis 1 survivor? Why? My mouse is doing the thing again. Look. How did I fix this last time? Did I just have to... I think I just restarted my computer, didn't I? Fuck. I don't care. I'll deal with it.
2008. Most people misunderstand that crisis. Subprime was really a small portion of the market. What ultimately caused the great financial crisis, or global financial crisis, some people call it, is a lack of confidence and collateral in these big securitization derivative markets. And so one day, Chase no longer would take Lehman's pledged assets, and then the whole sort of market fell apart. And so that's important.
Wait, what?
Because
so they just panic. It's a panic.
It's panic.
Okay,
it's a confidence game.
It's a panic. It's a confidence game. Yeah, because it was a bubble. Yeah, that's definitionally what a bubble is you have overconfidence in a market, and then the price is probably departing from the true value of the underlying asset, and then at some point people are like, this is probably not real, and then you have a correction, and then that correction, depending on how brutal it is either a crash or a recession or a depression.
Essentially what happened is kind of the entire financial market imploded. And what we need to understand too, for historical perspective, is that the shadow markets, where those derivatives trade in that off balance sheet sort of securitization market,
right,
that is now much larger than it was back then. So, let's keep that in perspective.
I talked with Steve Eisman, actually, of The Big Short. Yes. We did an interview, and he mentioned some of this, which is that the rules changed for banks after the Great Financial Crisis to add some regulation, but then all of the shady lending just went off the bank's balance sheets onto these private lenders.
It didn't. That's not where it all went. It went onto the balance sheet of the government-sponsored agencies. So when the banks pulled back because of those Basel III requirements and sort of all these restrictions, you needed more capital if you were going to hold mortgages that weren't backed by the government. The lending went in the shadows, but who was buying what was being those loans? That was Fannie Mae, Freddie Mac, FHA, or Ginnie Mae.
So can I go ahead. I want to make sure I understand this mechanically. So if I'm a private lender and you want to buy a house, and so I don't do a proper credit check or whatever, I give you more money than you can probably afford, then I can flip that and sell that back to the government, so there's no risk on my balance sheet. Is that what you're saying?
Well, it's not even so in that scenario, you're giving more agency to that lender than they actually have. It's so regimented the way that you have to do this underwriting. So let's say I'm Rocket, and I'm going to give you a mortgage. I'm going to use the underwriting, the automated underwriting tool.
What are you disagreeing with here, bro? She's saying basic stuff about derivative markets that are true, including the GFC kickoff. The big issue, the reason why that financial crisis hit so hard domestically and internationally is because, in my opinion, I guess, is because what you did was you found a way to plug in international investment. You found a way to plug that in to the domestic U.S. housing market. And once that got plugged into that, once your international pool of money got plugged into your domestic housing market, and then because of the way that there's a bad combination of like the way that leveraging works. So I only have to give a little bit of money to get access to a big asset whose increase in value relative to the amount that I invest can go up massively, right? So because of the leveraging that you have on domestic buyers, and then because of the international pool of money that are now plugged into the investing into these domestic buyers, right? And the investment being that the MBSs and the CDOs that were sold incentivized more people to give these loans, that caused the underlying asset, the underlying fundamental asset that was powering all of this, homes, now were dramatically being inflated in price because it wasn't just about people buying homes. It was about international pools of money looking for safe investments that had a guaranteed rate of return. That was the global financial crisis, not just shady loans or not just derivative markets or not just it was the plugging in of those two things is what made all of that be such a clusterfuck
of the agencies to approve that loan. And so the agencies program this tool. They're the ones that are fully underwriting this stuff. You're just kind of the person checking the boxes to make sure that it fits into their box. Now, what happened with all that crazy regulation on the lending side, Dodd-Frank, is they actually removed the debt to income threshold in 2021 very quietly. Nobody knew it really happened because they already found that I think it was almost 1 million Fannie Mae, Freddie Mac loans did not fit into this qualified mortgage.
Is that true? A bank will not test you. There is no debt to income ratio calculated anymore when you're getting a mortgage? I don't believe this, but it might be true. I would be curious if somebody can link me that. That doesn't sound... So you basically agree with her. You were trying to over-explain it to be contrarian. No, I think that her explanation is too simplistic because people will oftentimes say every single bubble related to housing can be like the global financial crisis, or every single derivative market is bad. All derivative markets are bad, or all derivative markets can cause a crisis like the housing crisis. It's not true. It was a very particular linking together of international capital to domestic housing markets. That linkage, that's in my understanding, I'm not a finance major, okay, but my understanding is the reason why banks that do mortgages aren't supposed to dabble in investment banking as well was to break that linkage so that that connection can't happen again. So derivative markets are good. Are you retarder? Yes, I am retarder. And derivative markets are fine. So all derivative markets were good. Then how did we get a crash? Derivative markets are totally fine. In the perfect world, derivative markets exist to allow people to more responsibly navigate financial markets. They work as hedges one way or another against extreme swings in things. They can help control for the amount of collateral you need. They can help control for uncertain outcomes to reduce, default rate. Like there's a whole bunch of things. There's nothing wrong. Anybody that's like derivative markets and they say bad is retarded. Saying a derivative market is bad is like saying debt is bad. It's a very simplistic, stupid way of approaching finance, in my opinion.
It didn't fit the new requirements.
So they relaxed the rules.
Exactly. They relaxed the rules. Of course they did. So basically what happened is the government stepped into where the private market was previously in that subprime. And that's government subprime. It's called FHA. This program used to be about those first-time home buyers that you're showing there. But it went off the rails. And pretty much anybody can use it if they claim that they're going to occupy that home. And it's a very low skin in the game, 3.5% down payment. You can have as low as a 580 credit score with compensating factors. I've even heard of more. Debt to income over 50%.
Yeah, my first loan was an FHA loan, I think with 0% down. Thank you, Obama.
I mean, these are like for someone who lived through the GFC and saw it on, I'll call the servicing side. That's after the loan has been made. And I saw what happened to those loans.
Okay.
I am seeing.
That's not the only function of derivative markets. Their main function is to increase activity in financial markets to allow for speculation and higher risk investments. I don't know if I agree with you, but I don't have the data to agree with you. Higher activity and speculation could be good because it allows for more price discovery mechanisms. And basically, your key answer in everything finance related, if anybody's like, why do we need this? I always say increases liquidity, which is probably true to some extent as well. I'm sure it increases liquidity. And liquidity is also good, I think, for like price discovery. And for, this is probably part of price discovery, but for people to be investigating the underlying asset prices and everything too. So, but my understanding is in big boy financial stuff, derivative markets exist primarily for hedges, to hedge against massively uncertain things. FHA are 3.5% down. They might be now. I think back when I got my FHA loan on my first house, I think they had offers for 0% down. But this was in, Obama was giving away, thank you, Obama, I think $8,000 first-time home buyer tax credit. I think I got this. I want to say it might have been 3.5%, but I think it was 0% down on my first home. But it was also, you had to pay PMI, something mortgage insurance until you hit like 22% equity in your home or whatever, some bullshit, I think.
Things now that I never saw back then. Much worse. And so basically the government, because they needed to juice the economy, they stepped in with these very generous programs. And then kind of the fraudsters took advantage of those programs, claimed that you're going to live on it. And that's mortgage fraud that we've been hearing a lot about. And they basically just flipped. This is what's so crazy is that FHA before the last cycle was about 7% of the market.
Wait, real quick. Can somebody show me, did they get rid of our debt to income ratios? Is this not a thing anymore? Okay. Otherwise, I don't know how you control for... People say banks don't care about DTI anymore because automated underwriting is hidden from borrowers nowadays. Oh, so they might just be factoring other things and the banks themselves just don't have access to the sheets or the algorithm, so retards might say it or something, maybe.
It's now almost doubled. It's between 13 and 15% of the market, and it's already over 10% delinquent. The percentage of subprime we had on our books back then, including FHA, was 12%. So percentage of the market prime we had on our books, 15 and 15% of the market, and it's already over 10% delinquent. The percentage of subprime we had on our books, the FHA before the last cycle was about 7% of the market. It's now almost doubled. It's between 13 and 15% of the market, and it's already over 10% delinquent. The percentage of subprime we had on our books back then, including FHA, was 12%. So percentage of the market, we're already higher with these kind of toxic loans, okay? But why isn't everybody screaming about this? Because 2024 was an election year, and the current administration wanted to win that election. And so they did one of the craziest loss mitigation programs I've ever seen. So, after the last crisis, what they did is these...
Well, again, a lot of people defaulting on their loans will not create another global financial crash. That crash was driven because of the international capital, in my opinion, that was massively overinflating the domestic housing market. Even if a bunch of homes go under, and even if a bunch of bad stuff happens to our housing market, it will never be at the level of what that global financial crash was, because you don't have the connections there, unless those connections have been recreated and I'm just not aware of it, which maybe they have. Maybe some regulations have been stripped away, but she's not making that argument. This lady doesn't sound like she knows what she's talking about. This sounds like a weird conspiratorial, like, abolish the Fed person, but...
loan modifications where you come in, you can say, hey, I can't make this payment. And they say, okay, I'll work with you. We'll see how we can change some of the loan terms so that you can actually get a lower payment.
This is wild to hear, because I did an interview with Bill Moreland. Do you ever heard of him?
Oh, I love Bill.
Bill Moreland. He told me the same thing about other aspects that the banks are doing, where they're
100%.
They're modifying
100%.
all of these commercial real estate loans, these auto loans. They're and they're just extending and pretending.
Extending and pretending. And then I want to mention something really quickly. The way we got out of that crisis, Wall Street came in and picked up all of those foreclosed homes for pennies on the dollar to turn around and do long-term rental. They kind of arrested.
I've never heard this in my life. I don't believe this. And she's just lying. Wall Street, all these companies suddenly turned into real estate firms? I think this is all and she's not quoting or citing or giving anything to. I don't believe any of this. I don't know.
Did the decline because we never really fully got back to where household median income supported the median home price. And so
after 2009, we never got back to
No, we didn't. Before COVID, you had to fully underwrite a loan again for a loss mitigation workout. In COVID, they said, nope, you don't need to do that anymore. In fact, they don't even have to call in. We're going to send the modification in the mail. And as long as they make their 3 trial payments, we're going to give them that modification. Doesn't matter if they could actually qualify for this. And in fact, you didn't have to call in to get on a forbearance. They just automatically put you on it. They could put 18 months of forborne payments at the back of their loan in a non-interest bearing lien to be paid off when the loan pays off or when they actually send the for a loss mitigation workout. In COVID, they said, nope, you don't need to do that anymore. In fact, they don't even have to call in. We're going to send the modification in the mail. And as long as they make their 3 trial payments, we're going to give them that modification. Doesn't matter if they could actually qualify for this. And in fact, you didn't have to call in to get on a forbearance. They just automatically put you on it. They could put 18 months of forborne payments at the back of their loan in a non-interest bearing lien to be paid off when the loan.
I don't even know if this sentence is real or, oh, this is the guy who one guys me. Can you explain, how does the FHA reconcile the actuarial spread between the upfront MIP amortization curve and the property value delta for subconforming markets? My professor says I'm retarded. Is that a real sentence? MIP is mortgage interest payment amortization curve and the property value delta for subconforming markets. I feel like this is actually a real sentence, but I might be retarded. How does the FHA reconcile the actuarial spread between the upfront mortgage interest payment amortization curve and the property value delta for subconforming markets? I don't know what subconforming market means, unless you're talking about the markets for those loans. Doesn't the way that it reconciles it, because the FHA is to some extent subsidized by the government, so you can afford to make loans that might not be ones that private investors would take risks on or private banks would take risks on. In the FHA, it's Federal Housing Authority, isn't it, definitionally? I think that was a real sentence. I don't know if you're trying to troll me or not. Fuck you. This is the current delinquent payments. Mortgage. Oh shit, we're going up. My brain is hurting. I hate econ. This is not econ. This is finance, okay?
Loan pays off or when they sell the home, which is kind of crazy town if you think about it. That's like a second lien mortgage, which was another problem we had back then.
Hey, I know Melody's throwing a lot of words at you.
What?
The back of their call in to get on a forbearance, they just automatically put you on it. They could put 18 months of forborne payments at the back of their loan in a non-interest bearing lien to be paid off when the loan pays off or when they sell the home.
Is this true? If you were in COVID and you owned a home, did you automatically just get a 1.5 year forbearance where you didn't have to make housing payments for a 1.5 year? I feel like I would have heard about this. Wait, I never got that. I didn't get this. I had a home. I don't think I had an FHA loan. Was this just for FHA loans? A 1.5 years of no housing payments for every single person on FHA loan? Or not automatically? I had to call and apply. I use Navy Federal Credit Union if it matters. You had to request it. Okay, maybe for people you had to go and request. Okay.
Just kind of crazy town if you think about it. That's
crazy
like
town.
A second lien mortgage, which was another problem we had back then.
Hey, I know Melody's throwing a lot of words at you. Some of it seems a little technical, so I want to jump in here and make sure you understand this part and explain it kind of plain English. What she's saying is that before COVID, if you were having trouble making your monthly payment on your house, your mortgage, you could go to the bank and ask for a reduction in payment. But in order to get that, they'd have to rerun a full credit check. They'd have to check your debt, your work history, your payments to see if you could afford even the new payment. Now, the lower payment, the part you're not paying is just put on the end of your loan. So you have to pay it eventually, but it would help you get through a tough time. During COVID, those rules were relaxed. You could now get the loan modification, the lower lower payment a lot easier. In fact, she's describing it. The banks would just send you a letter saying, hey, here's your new lower payment. Just fill this out. It was just very easy to get stuck on a lower payment and then keep paying on a house that was more expensive than you could afford. And all of that payment that you couldn't make was just continually added to the end.
Well, but she was saying that it was added with no interest at the end. So technically that's, in a strictly financial sense, that's beneficial because you're not paying interest. It's just time value of money. It's good. And also, would they really stick you on that new payment plan forever? I seriously doubt that. It was probably for some declared period of time.
Additionally, she mentions forbearance. Forbearance is when you don't have to pay your mortgage at all, which we had during COVID for 18 months. So if you couldn't make payments, you could have up to 18 months of forbearance and just ignore paying altogether. Now, all these things you could say are important emergency measures to keep things going during COVID. But what they did was create some real distortions in the market. It allowed, again, housing prices to stay higher for a lot longer and make people afford things that they couldn't afford for a lot longer. And we're just now beginning to see the unwinding of all that crazy free extra money.
Well, but it was trying to counterbalance the fact that people had no money because the economy was shut down because of COVID too. So when you say afford things they couldn't afford, yeah, that was the point. But that was probably a good thing in that time, right? If the economy is going well, you don't want the government to come in and distort a bunch of markets and give free money because now shit is going to get inflated. It's not good. But if there's like a sincere economic crisis, this is when you want the government to step in and quote unquote inflate markets a bit, right? You don't want everything to crash and people to get kicked off their houses and everything, right? The forbearance source. How many people, is this only for FHA loans? FHFA announced extensions of several measures to align COVID-19 mortgage relief policies across the federal government. I wonder how many people, what percentage of people even took advantage of these? This is for conventional loans as well. Okay. I wonder how many people took advantage of these.
So I just want to, simplify what she was trying to say there. Okay.
On the Fannie Friday side, they didn't record those on public record. Okay, that means nobody knows it's really there, unless you run a credit report. But I'm finding a lot of servicers aren't reporting correctly to credit. So this is where we have to stop ourselves and say, why have home prices continued to go up? Why have we not had delinquency? Because we had intervention on a scale I've never seen. And then, as if that wasn't enough, because in June of 2023, FHA was just, delinquency was soaring. They knew they had to do something to get through the election year. They did this crazy partial claim advance loan modification where essentially you could get your loan, not pay for the first 3 months, go and say, I'm so sorry, I can't pay. And they say, no problem, we're going to give you a partial.
The 2008 mortgage crisis was caused by the recession, not the other way around. The recession itself was caused by tight monetary policy. Europe experienced a worse financial crisis during the time, despite not having a domestic mortgage crisis. What about your mom getting fucked in the throat?
They knew they had to do something to get through the election year. They did this in June of 2023. FHA was just, delinquency was soaring. I've never seen. And then, as if that wasn't enough, because in June of 2023, FHA was just, delinquency was soaring. They knew they had to do something to get through the election year. I
don't see the delinquency soaring stuff. And 2023 is not an election year, but
did this crazy partial claim advance loan modification where essentially you could get your loan, not pay for the first 3 months, go and say, I'm so sorry, I can't pay. And they say, no problem, we're going to give you a partial claim, which is that little non-interest bearing lien I'm telling you about.
Okay.
You could pay for 3 more. You could not pay for 3 more months, go back, get it again and again and again.
I just don't believe her. I don't think this is true. I don't think this is real. I don't believe this.
And again, there was no limitation on it.
Does that extend till now? So you could have gotten a house and just not paid for.
It's so disgusting. That's correct. And that's what investors did. There are actually whole rings.
Investors? You're saying these weren't even programs available to individual homeowners. There were investors with investment property that had this available to them? I don't believe this.
Can I ask? I want to ask. Because, so you say investors. I want to make sure they get it. Yeah, it's complicated. And I don't even get all of it. So let me understand. So you're saying investors a lot. I want to make sure, what I'm hearing from some people is that they don't know this tactic for getting a house so who's taking advantage of this? Is this like people trying to farm?
Say Wall Street or institutional investors. Bonus points if you can work hedge funds in here somehow. Wall Street, institutional investors, hedge funds for bonus points, or name Blackstone or BlackRock.
Airbnbs, is this larger investing corporations? Is this like who is using this mortgage fraud to buy up and bid up the price of all these houses?
So it's a lot of the Airbnb bros, short-term rental, that kind of thing, but also the builders have figured this out.
Okay. They build it and then sell it to themselves, basically?
Well, they build it and then sell it. They underwrite it.
Why would do builders usually buy the homes that they build? I don't think builders are true. The Airbnb buying and shit is kind of obnoxious. I don't know how much that actually impacts, like what the percentage of the home markets those are in cities, but.
And then they sell it to the GSE. When COVID hit and everybody wanted passive income, they would go into what we call a non-qualified mortgage bank. That's where you do these private loans like debt service coverage ratio loans. And the bank would be using this tool called, one of the tools is called AirDNA that said, if you buy this house in Kyle, Texas, which is 20 miles south of Austin, you can make $600 a day about 55% of the time of the year. Well,
that's like a program telling you
exactly
the profit you'll make on an Airbnb.
Correct. And the banks were using it. The non-banks were using it. But the thing about it is you're only going to get that Airbnb rented in Kyle, Texas during South by Southwest.
Yeah, I mean, how often is it's not running $2 a day every day.
When you have 15,000 other short-term rentals to choose from in Austin, yeah, you're not getting booked in Kyle, Texas. This was what people were thinking. And so these banks would actually say, why buy one? You can buy 10.
Oh, I mean, I remember in this era, I mean, this is 2021 onwards, right? This is
right.
Okay.
Yeah.
I'm sorry. I don't believe any of this. I'm going to need to see some data on this. This just sounds like total conspiratorial nonsense.
In this era, it was all over social media where people would be telling you to buy Airbnbs. It was great passive income. You get 10, 20 of them. Don't get one, get 10.
Exactly.
Okay, yeah.
And they were selling them on Facebook. They weren't even selling them in the traditional market, which is one of our problems, is that we don't understand exactly what happened. And so basically everybody piled in. And by the way, our veterans also did this. They used their veteran benefits. I've talked to several of them that did this.
And then bought a bunch of short-term rentals.
With their veteran benefit, which was supposed to be meant for your primary residence. So it's
usually you have to commit mortgage fraud if you're lying about, like, sometimes there'll be special mortgages or loan terms available for people who are buying a primary residence, like that Obama tax credit for buying your first home, or certain FHA loans. I think, don't quote me on this, but I think that's only supposed to be for your primary residence. So, I mean, you could do whatever she's talking about here, but you're committing mortgage fraud at that point, I think.
Everywhere. And this is so what a lot of people think is, the housing market is, it's fine because it's about people that need to stay in their homes, right? Remember the Big Short is like, people always pay their mortgages, The problem is this is not your mom and dad's housing market. This market is people think is, the housing market is, it's fine because it's about people that need to stay in their homes, right? Remember the Big Short is like, people always pay their mortgages, The problem is this is not your mom and dad's housing market. This market is about investors. That's it. First time home buyers.
Did you say, remember the Big Shorter is people always pay their mortgages? I'm pretty sure that, again, the drive up, the issue is just that the equity in your home would increase so fast. Even if you couldn't pay your mortgage, you could, because you could always take out a loan against it or do some weird refi thing, or because there's so much equity to be had in just buying a home ever. And the increase in value is so insane always.
Are the lowest that they've been since they started tracking it in the 80s. I met with one of the biggest institutional owners a few weeks ago. Yeah. They are net selling. As soon as
institutional investor, I cummed.
Those leases are up, they're rehabbing and they're selling because they know, number one,
so they see stress? Flowing. They see stress?
Oh, they see a lot of stress because they can see in markets like Atlanta, it's oversaturated because we haven't started talking about how the builders went bananas and just started building.
I think of all the housing markets that I've ever personally looked at, I think Atlanta is the most fucked one in terms of, broadly speaking, people talk about institutional investors, it's bullshit or whatever. I think Atlanta might be the only major city where that might be a legitimate claim. I don't know why or what specifically happened in Atlanta, but they have a lot of shit in Atlanta. I don't know why.
Building like crazy. And we don't know how much because the survey of construction is how we understand what the permits are. But there's a lot of places in the country you don't need a permit. That's one thing. Secondly, we've gotten much lower participation in these surveys now.
Oh, yeah, that's all the economic data lately. Is
exactly. And so
I think I've heard you speak about this, and it's a question that I think breaks a narrative that I had. Because I think a lot of what people think about this housing market is that it's a supply issue. We don't have enough supply, right. And that's why the prices are skyrocketing up. But the way you tell it is that they've been building like crazy. It's just that the things that are propping up the sales are not real human demand of people buying their houses. It's investors or it's other things. So can you drill into that a bit? It's not a supply issue.
No, because here's what everybody did, and this is such an important part of the story. It's like you'll hear the housing narrative that says we stopped building after the GFC and we're short 6 million homes. It's like, okay, but have you taken a little gander at the fact that we're not having babies at replacement rate anymore? Have you looked at the fact that the boomers, unfortunately, between 2025 and 2035, 15.6 million will leave us, and they own the majority of the homes.
Right.
And then another 26 million from 2035 to 2050. Did you take that into consideration? And then the other thing, it's like,
Do you mean Atlanta, Georgia? What other Atlantas are there? Wait, what the fuck is she saying?
There are 26 million from 2035, 15.6 million will leave us, and they own the majority of the homes.
Right.
And then another 26 million from 2035 to 2050. Did you take that into consideration? And then the other thing, it's like, did you actually look at the housing stock right now? We have, per the census, 15 million vacant homes, not abandoned, vacant. That does not include the over 3 million seasonal properties, of which probably people estimate we have about 2 million to 3 million Airbnbs in this country. That's probably some of those. But again, this is also lag data.
Sure.
I can tell you everywhere around me there's vacancy, everywhere all over the country.
One of the easiest ways to know that a person has no concept of how housing markets work or that they don't know anything about the housing market is when they quote national level vacancy rates. Go look at a map at where the vacancies are, and then go look at a map at where homeless people are or where the highest rates are. You do not have the vacancies are in cities in Montana and Wyoming. You don't have massive vacancies in New York City, LA, San Francisco, Miami. This is one of the most common brain dead traps where when I hear somebody say this, it's like instantaneously like you have no idea what you're talking about.
One thing you I think is so incredible about your work is that you will go and drive to these lots. You will drive to these real estate
these new builds.
Yeah. And you will see that they're mostly vacant or they're not.
They're mostly vacant, as are the new multifamily luxury Evergrande.
Yeah. And you will see that they're mostly vacant, or they're not.
They're mostly vacant. As are the
one thing you I think is so incredible about your work is that you will go and drive to these lots. You will drive to these real estate
these new builds.
Yeah.
Well, I mean, if you're talking about like literally a newly developed area, I mean, isn't this where you would expect any vacancy to be? But also, don't they pre-sell a lot of those homes? But this is not. What does this have to do with anything? Newly developed areas. So these are not like your big cities where people are trying to buy home, where people are trying to move to, right?
And you will see that they're mostly vacant, or they're not.
They're mostly vacant, as are the new multifamily luxury, Evergrande style, all over the country. But the way that you can just do this in simple math is take our population and divide it by housing units. And, this is where I ask people.
You know what? Queen. She's a queen. Because you know what? This is my talking point. This is what I say. Hey, you can't afford to live where you are? Well, then fucking move. Motherfucker, just move. You can't find a house? Really? Tell me about your housing problems. Well, so I moved out of my parents' home from Bellevue, and I wanted to move to Seattle. And whoa, excuse me, Seattle? And you're trying to find a house? Might I suggest the state of Idaho? There's a lot of vacant housing over there, motherfucker. Just move. Go to where the homes are.
What do you think the average household size is today in the United States?
I have no
Any
idea.
clue?
I have no idea.
Okay, well, when I was growing up, it was 4.2.
Yeah.
That was the average household size.
I have
This is where I ask people, what do you think the average household size is today in the United States?
I have no
Any
idea.
clue?
I have no idea.
Okay, well, when I was growing up, it was 4.2.
Yeah.
That was the average household size. And people would always make a joke, or when it went to 3.5, like the half's, a pet or something like that.
Sure.
Well, right now it's at about 2.55.
Oh, wow.
2.55. And so I have a friend, Kenny Cat PhD, who says, is the goal to get to one house per person? Because what kind of society is that really going to be?
Right.
So for the longest time, that number was going down. It's now stopped. And I have a feeling we're about to see it grow, that average household size grow again, because people are having to make really hard choices. Like, for instance, I moved my mom in with me as opposed to buying her a new home, which I had considered, but it just didn't make any economic sense now with property taxes and insurance increasing. Because what we saw in
I'm so confused. This lady is so crazy. That's a good decision. What do I do with my mom? I had to move her in with me. That's an appropriate consumption of housing decision. Why does your mom, who sounds like she's an old person, she needs her own fucking house? Why would you need the fact that you were even considering, should I buy my mom her own house to live in? Why the fuck does your mom need her own house? What? Boomers, man.
COVID was we kind of pulled forward demand. We pulled the millennials forward a little bit faster because of all that stimulus, which, it wasn't their $1,600 check or whatever that was. It was their parents getting the PPP money. I mean, it was their parents getting the ERC money,
Parents getting the PPP money? That would just replace their paychecks. What is she talking about? That just what? Unemployment insurance as well?
Or an idle loan or whatever.
Yeah.
And so we pulled forward that demand. I cannot tell you how many 30-year-olds I've heard they're like, yeah, I bought this house to fix and flip. And yeah, I haven't been able to do anything with it because everything just got too expensive. But everyone was doing this.
100%. No, I hear that. I'm in my early 30s. I hear this all over. You talk about hard choices. I mean, there's another graph I wanted to mention. This is about the most common living situation for young adults in both Britain and America. It used to be living as a couple with children. Today, it's living with their parents. I think a lot.
The most common situation for young adults in Britain and America used to be living as a couple with children. Today, it is living with their parents. Share of 18 to 34s with different living arrangements. From 1980 to 2020. So this is where I really wish for graphs like this. You need to show these with other data points, or you need to disaggregate your ages a little bit. Because if you have like 18 to 34, let's assume that college age is 18 to 23 or 18 to 22. If your share of kids in college is dramatically increasing, then you would expect this to be pushed out a bit, right? You would expect them to have a higher percentage of people living with parents. That would make sense. I wish they would break this out. Like, what does 18 to 22 look like? What does like 22 or 23 to 35 look like? I feel like it's important to take into account here. There's still, just because housing has gone up in price, I believe, I'm pretty sure. Like, I would still expect to see that number going up, but I don't know if it would be as dramatic. I'm not sure.
A lot of people are having to choose to live with their parents because
Actually, wait. Hold up. Wait, there might be a really insidious secondary thing hidden in here as well. Yeah, wait. What about people living with no children? Never mind, actually. I wouldn't factor this graph in at all. I think this is a totally meaningless graph. The college thing already kind of, whatever, maybe. But are we not factoring in people who just live and don't have kids? they are so small that they can basically be ignored. Are you sure? Because if we add up percentages of people, this is 40% plus 20% is 60%. Does that mean that 40% of 18 to 34-year-olds are just living independently with no children? Is that how I'm supposed to read that? Or is there another category that I'm not thinking of? You can either live with your parents, you can live independently with your own children, or living with children and parents? Is that a thing? Because in that case, 40 and 20 is 60, 40%. You'd basically be tied for living on your own or with a partner, living independently or living with parents. I don't know. This is... Yeah, I don't know about this one. Chief. In my opinion, you're over accounting for college attendance. Do you think so? I feel like anybody that starts working at 18, especially if they have a partner, it's going to depend on where you live. In richer areas, probably not. But I feel like in poorer areas, at least when I was growing up, if you start working at 18 and you save a little bit of money and you get an FHA loan, or you have a parent co-sign for it, you probably make your first, probably have your first house by like 23, 24. Assuming you live with your parents, you're saving money, and you live in a shitty area, you're getting like a $100,000 house. But if you come out of college at 22, 23, you're not buying a house at 20. You have all your debt, you don't have a job, you have no work history, you have no credit. Living with roommates is a possibility too. I'm thinking back on my day for a $100,000 house. Today it would have to be a more expensive house, but also in my day, minimum wage was $5.25 an hour. So fuck you guys.
Because the financial reality does not make sense. And I wonder, I want to.
Which is why they're not having babies.
Exactly. Yeah, I think there's a strong tie in there. And why they're, looking for political change so dramatically.
Correct.
I mean, they're not feeling sure.
The cheapest homes in my area are $450K. Yeah, if you live in a wealthier area, then it might not be. Then this might be harder to do the wealthier the area you live in. Maybe, I don't know.
By the government. I want to see where this is sort of heading, because the picture you're describing is one that cannot stand. The financial reality doesn't make sense. So I want to see what you see. How do you see this playing out?
The biggest reason I think that nobody wants to accept as to why home prices haven't gone down is because of the narrative out there in mainstream media. I mean, they are just, and what I finally realized as well, and I feel like a useful idiot after following this data religiously, is that they're modeling the numbers. These aren't actual results. And I've now caught it several times, meaning that we don't have any good gauges of what's really going on out there. But to your point, the narrative is breaking because everybody can see all the for sale signs in their neighborhoods, Or
you go on Zillow and it's like price cut.
Right.
Everything is
right. Yet somehow NAR, our National Association of Realtors, says that the median list price is exactly the same as it was a year ago. How's that possible?
Wait.
Narrative is breaking because everybody can see all the for sale signs in their neighborhoods, And I've now caught it several times.
Where I don't drive around a lot, I guess. Where are all these for sale homes and all these people? I don't know if you see these huge outflows. Even when people say like everybody's leaving New York City or California, I don't even think this is happening anymore. I don't know what this is.
Meaning that we don't have any good gauges of what's really going on out there. But to your point, the narrative is breaking because everybody can see all the for sale signs in their neighborhoods, Or
you go on Zillow and it's like price cut.
Right.
Everything is
right.
What is he saying? Price cut or price gap? Price cut?
Yet somehow NAR, our National Association of Realtors, says that the median list price is exactly the same as it was a year ago. How's that possible? Like, it's not even statistically possible.
Right.
What do you mean? There's a million reasons why it could be possible. There's tons of countervailing forces on interest rates. It could be as consumer aggregate demand falls or whatever and wages fall, that could bring the median prices down. It could be interest rates going up or down, could increase. There's a million reasons why prices could rise or fall. What?
Right. I remember vividly them saying things like,
what did you think happened to housing prices after the crash in 2008?
Survive till 25 in 24 and marry the house, date the rate.
Date the rate. Oh,
but the rates, even though in 24 and marry the house, date the rate.
Date the rate. Oh,
but the rates, even though interest rates have been cut by Jerome Powell, the mortgage rates haven't gone down. I think they've actually possibly even gone up. But how would they survive? Is it now survive till 26? What are they saying now that none of those things paid off? We're near the end of the year.
I don't think I think they're in this weird place where they know that the only way they're going to get people to the market is to talk about price cuts. So I get like 800 emails about price cuts from these various listing sites. But I think they still believe that if they get you in in the door, they can get the price they really want. And so they're in this weird moment where they're just kind of praying and hoping that, I call it hopium, right? That, that the bond market will respond.
Right on Twitch. Everyone says hopium here.
You know, what we're hearing is, you know, defaults are regional, which was a narrative back during the GFC. And that's what they say. Well, Florida, Texas, they're a problem. And that's what everybody would say to me. And that's where I started, because that's where the problem was. But I'm like, no, California's in trouble.
So that's what I've said. Because I want to be safe when I make any proclamations. I'm like, Florida and Texas clearly seem like they drastically overbuilt. So bad. The demand is not there. But can you speak more to the rest of the country? This is a broader problem.
Sure. Yeah. So California, we got to look at California. Like, firstly, how can you make the argument that everyone is leaving California to come to these cities? And believe me, each one of those cities built as if every California make the argument that everyone is leaving California to come to these cities. And believe me, each one of those cities built as if every California or New Yorker was coming to their city, and yet think that California home prices are going to, you know, sustain at these higher prices when you've had like in LA County over 300,000 people leave. People think there's a housing shortage because, well,
well, housing prices can still increase. They just wouldn't increase as fast. And there's also other people that are putting pressure on housing prices that don't live in California. Other people want to move to California, right? Like what?
There's a housing mismatch because out in California, what a lot of it is you have these mom and pop investors. And so there's not a lot of owner occupiers out there. It's much lower than the national average. And so in California, you have many problems. You have the affordability problem, you have the demographic problem, but their narrative was so strong that has completely cracked. San Diego, for instance, where people told me because of the DOD, that was never going to be in trouble. You can look at all of the Airbnbs there, over 12,000, and no, absolutely they're in trouble. And you're seeing it year-over-year price declines. So we move out across the country from the South to California, the Midwest. They are going to take probably the longest, it'll be between the Midwest and Northeast to really correct, because every investor who was kind of bummed out in 2022 when rates rose, were told, go buy in the Midwest because those homes are still cheap. So you can still cash flow and buy there. So they did. So you are just now starting to see inventory growth.
Do you believe that housing is a good asset to hold, but most Americans are overinvested into it? I think that treating housing as your best investment for a family, I think is the most retarded thing. It's a very American-centric idea. It's stupid for a variety of financial reasons that we've gone over in the past. I'm not going to go over it again, but I just think it's a very stupid American idea. A home primarily is a thing that you need because you need a fucking place to live, okay? The fact that people treat it's a worldwide thing, bullshit. Only in the sorry, I'm getting too mean. Maybe in other places there are, but in every European place I've been, the idea that like you need a house, otherwise you're fucking bullshit. Like at least in all the European cities I've been in, houses are like things that old people get, or you get when you're ready to leave a city. But the idea that like you're a fucking, like in the United States, it feels like people think if you're 30 and you live in an apartment, you're a fucking loser. That's the feeling in the US. You're 30, 35, and you live in an apartment, you failed, bro. Kill yourself. You're a fucking loser. Whereas in Europe, it's like, okay, well, I want to live in a city. Obviously, I'm not going to have a house, right? Or you're going to have a dinky, rinky, dinky house. That's the expectation. But in America, the expectation is, I'm 30 years old. I'm 5 years out of college. I should have a house in Brooklyn or in LA or in SF or in Austin. And if I don't, then my life is over. Like that's, I don't know. This is a very American idea.
Are still cheap. Who was kind of bummed out in 2022 when rates rose, were told, go buy in the Midwest because those homes are still cheap. So you can still cash flow and buy there. So they did. So you are just now starting to see inventory grow there again. And
who cares because of leverage? It's the best investment you can make. Who cares what you ought to when the reality is different? The issue is you're talking about leverage, and leverage is an investment term. And people that treat their home as their primary investment vehicle are too retarded to take advantage of leverage, because the entire concept of leverage, that you're leveraging some smaller amount of money to a larger amount of money so that the percentage growth of the larger amount of money confers an absolute gain to you, is erased when all of the leveraged earnings that you have are just used to buy another leveraged product, which is another home. Leveraging, to say that leveraging is positive here in an asset value or in a net worth sense only makes sense to say like, what? So you have $100,000, Destiny, and you want to invest it in the stock market? Yeah, I think it's a good investment. Well, aren't you fucking retarded? Because I took my $100,000 and I invested it in a home. Wow, well, I think that my S&P 500 is going to outgrow your home. You would say that, Destiny, but that's because you're retarded. I didn't buy a $100,000 home. I used my $100,000 and I leveraged it to buy a $1 million home. So now my $100,000 is appreciating like it's a $1 million investment. And what do you have to say to that? It's like, oh, wow, that's crazy. So you've leveraged your $100,000 to $1 million investment, and now that leveraging is allowing you to make more money off of your initial investment. That's crazy. What are you going to do with all that extra money? I'm going to leverage it to another house. Oh. And then what? Another house. Oh. So you never actually have access to that money. You never have access to that capital. You never get anything. You're just using it to buy homes. Like you've taken real money and then turn it into monopoly house money, and then you're bragging because your net worth is increasing in a way that it makes no material difference to your financial health, except for when you die and you leave your house to your kids. Listen, I'm coming down a lot on housing right now. It's not bad to buy a house, and there is an appropriate financial health that incorporates owning a home. I'm not saying that it's always bad or that it should be. I'm just saying that people dramatically over-index on this concept of having a house and that it's the most important financial issue. Okay. That's all I'm saying. Destiny, you can sell the house, retire and rent until you die. Are you the guy who said leverage? Now, if there were people that did that, I might agree with you, but in my personal experience, and now here, I am telling you, my family is the classic white middle-class family that is mind-fucked on lifestyle creep. So maybe there are other family styles or family types that do this, and I just haven't seen them. In my family, you never downsize your house. You would never do that. That's like an absolute capitulation in life, and you should kill yourself. The idea that you would go from owning larger and larger homes and then now in retirement you're going to sell your fucking house? Of course not. You keep that because it has all your stuff. You invite the grandkids, and then you are, I would call it an overconsumption of housing. Now you've got two old people who live in a home with 6 bedrooms on the off chance that maybe your family visits once a year, but none of them are visiting because they're also all wasting their money on cars and homes and stupid fucking shit, right? So maybe now if there were people that responsibly adjusted their housing consumption to match their lifestyle, then maybe I would agree with you. But even listen to this lady. Remember at the beginning, she was like, yeah, my mom was getting old, and so I thought about buying her a house. Why? Your mom needs her own house? She gonna mow the fucking yard? What? Like it's I love everybody, okay? But listen, Americans are just fucked when it comes to housing, in my opinion. YouTube drama has a fun thread about you. YouTube drama Reddit. That thread, or that subreddit is a super commie tanky one. They hate me, and I love it.
Cash flow and buy there. So they did. So you are just now starting to see.
Oh, this one? Streamer Destiny, who's being sued for revenge porn, films himself harassing an official witness to his court case. I saw that one. She's not an official witness, by the way. And she ran up to me and harassed me. Based.
Because those homes are still cheap, so you can still cash flow and buy there. So they did. So you are just now starting to see inventory grow there again. And Indianapolis is in a lot of trouble. A lot of people bought there. So that story is of two things. It's one, it's going to be later because there was a lot more investor activity after 2022 than everywhere else. And then
I hear a lot of old people in California complain that they can't sell their homes because their property tax would increase so much on the new house they couldn't afford it. True, but that's because California did the most retarded thing ever on property taxes, and they made it so basically your property taxes don't go up in your house. It's just fuck it. Just housing is fucked, okay?
Two demographics. Everywhere in the Midwest suffers from negative demographics.
Yeah.
And then you come over to the Northeast and they have just lost the plot. I mean, it's just this idea that they're just immune from, like New York City, but it's because people don't leave their houses anymore and just walk around. The last time I walked New York from top to bottom, I'd lived there for 7 years. I hadn't done that in a long time because you fly in for your meeting and you fly out. For investor activity after 2022 than everywhere else. Right. And then inventory grow there again. And Indianapolis is in a lot of trouble. A lot of people bought there. So that story is of two things. It's one, it's going to be later because there was a lot more investor activity after 2022 than everywhere else. And then two demographics. Everywhere in the Midwest suffers from negative demographics. And then you come over to the Northeast and they have just lost the plot. I mean, it's just this idea that from
I feel like the Midwest has always had issues with this, but I'm vibing that a lot. I just know that when I lived in Omaha, there was always this huge fear of like people go to school here and they flee for the coasts, or ideally you don't even go to school in Nebraska, you would go to the school on the coast. But I feel like that's always been like an issue of Midwest flight or whatever. But
negative demographics. And then you come over to the Northeast and they have just lost the plot. I mean, it's just this idea that they're just immune from, like New York City, but it's because people don't leave their houses anymore and just walk around. The last time I walked New York from top to bottom, I'd lived there for 7 years. I hadn't done that in a long time because you fly in for your meeting and you fly out.
Sure.
The city's empty. It's empty. It's empty. Like, of course, not in Times Square. Of course, in these tourists, but nobody is there compared to what it was like when I lived there in the early 2000s. And why is there an apartment shortage? Because of a 2019.
Well, I just don't know. I don't know.
Law that said you can only raise rent a certain percentage, and they couldn't even make the repairs that they had to make to meet code. And so I've heard upwards to 100,000 apartments sitting empty off the market because they can't afford to make the repairs. They're just hoping the law will change so that they can charge enough rent to be able to make those repairs.
Right.
Like, it's insane.
Well, sure, because what you're saying is that a lot of these houses are being bought by investors who think they can make a profit off rent.
Wait, okay, I could be wrong. I thought rent control only applies to like currently occupied units. If a unit is no longer occupied, don't you have a lot more flexibility in raising the rents? Or I don't know if maybe I guess rent control works a little bit differently everywhere. So I don't know.
With the rising rents.
Correct.
So in an environment of falling rents and less population, it doesn't math out anymore. And they plan these out. I mean, I assume they penciled this out for 10, 20 years. I mean, they've planned this to work, right? When they've made the purchase.
They did.
Yeah.
February 8th, 2024. New York City's vacancy rate reaches historic low of 1.4%, demanding urgent action and new affordable housing. To be favorable to her point, which I shouldn't be, she's saying that they literally just taken whole units off the market, so maybe they wouldn't even show up as vacant. I don't know if that's true or not. I guess you could just look at the number of housing units available.
But most of them weren't.
Well, they didn't care.
I mean, they were just watching whatever influencer. And I mean, I just got off the phone with one who, unfortunately, she's lost all of her investment except for one property out of 10, which she's likely going to lose that too, because, you know.
What? Wait, what?
I mean, I assume they penciled this out for 10, 20 years. I mean, they've planned this to work, right? When they've made the purchase.
They did,
yeah.
but most of them weren't.
Well, they didn't care.
I mean, they were just watching whatever influencer. And I mean, I just got off the phone with one who, unfortunately, she's lost all of her investment except for one property out of 10.
What is she has a friend with 10 investment properties. Well, like 9 got foreclosed on. She lost. Or what does she mean?
Which she's likely going to lose that too, because, you know, they just saw these influencers. They just got a brochure that said
it sounded good, right?
In Arizona. Oh, I can't blame anybody. I mean, honestly,
what the fuck is she talking about? Wait, what? This year, rent in my state for one bedroom float around $1,900. Rocket Mortgage reports a 10.9% increase in average mortgage from 2023 till 2025. This is also a state, one of two, where historically more people leave than stay. CT/Illinois. Okay.
Like, if you didn't know what you were doing, you had a little extra cash, like it sounded smart, right? And then you had a bank telling you that that was right, and a program that said you can make that much money. You always need to do more due diligence than that. But
what is she talking about? We just buy an extra house for memes? What?
I also understand why it happened to a lot of people.
She had a friend who could afford 10 investment properties. What is she talking about? What?
The thought you might have while listening to what you're saying, especially if you're someone who's young who can't get on the property ladder. You're talking about the possible pain of someone who gambled on a Airbnb, someone who's a boomer who owns too many homes. Like, I understand. I do get it. This is real pain. This is people who are lied to and made decisions that are financially beneficial. But I think there's a sense of like, well, they had it coming and I want my housing prices down. I want a chance to get on the ladder too. Like, what do you think about that? Is that...
Listen, we can't wish harm on others, you know, and let's not dance about it, right?
What do you think her central thesis is? Good question. I don't know. It sounds like she thinks that the increased cost of housing is all illusory and it's driven by Airbnbs, institutional investors, and individual investors buying too many homes and not living there. It's basically like this is like a really common housing myth, and it gets told in a lot of different ways. But basically, the myth goes something like this. We have all the homes we need, but there are boogeymen buying the houses and either not living in them or artificially increasing the rents, whatever that means. And then people will tell this story in a lot of different ways.
But we can't have a society where people don't have they can't believe in the American dream. Shelter is a primary need.
Shelter? See what she just did there? Americans have this, this is such an American idea. The Americans don't want shelter. They want to own a home. If you want that as part of the American dream, that's fine. But like, that's not sustainable in the modern city, in the modern era. No other country like really expects this in the way that Americans do. It's just not possible.
I think a lot of people want to get a home ownership for all the wrong reasons. They think that home is going to appreciate, and that's going to be how they're going to make their wealth. Unfortunately, because that's what a lot of these Airbnb bros did, is they took out home equity. You know, They did a cash out refinance. Unfortunately, what I'm describing with our demographics are
also owning a home as an individual is completely different than an investment property. The reason why you're theoretically you're gaining net worth and everything is when you own a home as an individual is because your investment in your asset doubles as the payment for shelter. But if you just buy an investment property, you need cash flow. You can't just buy another property and say, oh, well, if I buy one home, I'm kind of like gaining net worth, so I should just buy 2 homes. No, that's, again, the comparison I always use is that's like saying that like, oh, well, I see all these guys out here that are making money, driving Uber or as taxi drivers. I'm just going to buy another car, and that car is going to be a good asset for me. I'm going to buy 10 cars. Like, no, you have to actually drive those cars as a taxi driver or an Uber driver. You can't just, the car doesn't make money on its own. An investment property doesn't make money on its own. You have to have people living there and renting out of it. You need cash flow associated with it. You need a property manager or something, or you have to manage it all yourself.
but for some, unfortunately, is that your median home price is going to attract your median income. It's not going to be this windfall. It's going to be that you're going to be able to afford shelter and pass that down to your children. But what I am saying is good news because
this meme of like passing the shit to your children this is the same meme of when the next generation of graphics cards come out, then the prior generation's prices will fall. It never happens, and it's bullshit. And that's not, that. Like, just think for like 2 seconds when people say that. Oh, like parents will pass their homes down to their kids. How old are you? Well, I'm 35. I'm 36. Are your parents alive? Yeah. Are they gonna die tomorrow? I guess not. When are they gonna die? This lady, I don't know how old she is. Her mom's alive. Parents are not. By the time your parents are passing their homes down to their kids, this is going to be like a second home. This is not like, oh, I'm out of college and my parents just died. Thank God I get a home now. That's not how that works. This is just a thing that's going into your portfolio. Or maybe if you're fucking homeless, maybe you lucked out. But like, bro, your parents live long. Life is long, motherfucker. Your parents aren't dying when you need your home the most. Your parents are probably dying at a stage in your life where your requirement for a home is going to be at its lowest, right? It's going to be you're getting deep years into your career. Hopefully you've got some level of financial stability. Like, your parents aren't dying at a time when you need their home. They're dying probably at one of the least times you need it.
It has to become affordable again because all of these investors are now in hot water and they can't cash flow. So this is good news for those that are really trying to make good financial decisions, which means don't get into debt. I mean, like everybody else, I say no to debt slavery, because that's how you're going to be.
I'm sorry. Oh God. Who linked me this stupid fucking video? I'm getting so
cash flow. So this is good news for those that are really trying to make good financial decisions, which means don't get into debt. I mean, like everybody else, I say no to debt slavery, because that's how you're going to be priced out, is if you are going out using buy now, pay later and just
Amen.
overextending yourself.
Yeah.
Like, so if you make.
Can you buy now, pay later homes? Is that a thing? Is there a buy here, pay here for buy here? I know they do it for shitty cars, but can you do that for homes too?
The smart choices, and you save, and you really, kind of even short-term treasuries, or, even just a savings rate or money market account, and you save this money, you are going to be able to take advantage of this, all of these headwinds to housing. And there's.
Why? One year, like, how are you doing? I'm doing great. I'm 26. I got $500,000 saved. Holy shit, bro. What are you invested in? I've got a money market deposit account that gives me 3% interest, or well, I don't know, maybe they pay more now because interest rates are higher, and I buy 1-year treasury bonds. Wow, bro. Who do you buy your crack cocaine from?
A lot of housing out there. So, to me, that is the good news of the story, but there is a lot of pain coming for people who most of their wealth is kind of, baked into that home and their perspective. It's called the wealth effect, right? It's how they try to get us to spend more.
So
what is the wealth? I just want to hear that. I just want to hear that explain. What is the wealth effect here? Okay, sorry.
I in this story, and you've told this story over decades. It's a decades-long story of us getting here. The recurring theme is that when things are tough, the government will step in to bail out people who have made these bad mistakes on housing. I guess my question is, what makes you think it won't happen again now in 2025, 2026?
Because they already have. So firstly, one, they already have. The people that were able to save it last time, they can't make any money in this market. That's the institutional investors. They're now net selling. In fact, the government will save it last time. They can't make any money in this market. That's the institutional investors. They're now net selling. In fact, the government will likely start buying from them. I mean, that's what I foresee. How the government will intervene is they'll probably start buying these homes from the builders, and the institutional investors are partnering with them with some sort of affordable program.
Why would the government buy? Why would the government invest money into putting more upward pressure on prices?
They've already passed it. Some of this in the BBB.
Yeah. How about like 3 generations? E.g., my kids just got out of college and my parents died at the same time. Does this happen? No. Because you're a greedy motherfucker and you will never pass wealth on from dead parents down to your children. You will always hoard it for yourself, and you and your wife are going to go and waste it on some fucking retarded shit or on a vacation or something.
Not saying they're going to buy, but these affordable housing programs, if you're at this, but they've already passed it, some of this in the BBB, not saying they're going to buy.
Wait, what the fuck what does the Better Business Bureau have to do with it? Wait, what in the fuck does it? This is like a rating. It's just like a fake ass bull. No one cares about the BBB. What is this? What? Oh, I like that. It's Boomer Yelp. True.
but these affordable housing programs, if you're at this point of adjusted gross income, below the poverty level,
she means big beautiful bill. Oh, so the editor fucked up. Sorry.
You'll be eligible with some sort of affordable program.
My bad.
They've already passed it. Some of this in the BBB. Not saying they're going to buy, but these affordable.
Oh, because she said it passed it in the BBB. Okay, if the editor fucked this up in the video. Sorry.
Housing programs. If you're at this point of adjusted gross income, below the poverty level, you'll be eligible. So I think they're going to do a lot of that. But here's the thing: like the only other thing they can do is give out homes. And do you want to be that person? Because the pitchforks will come out. So I think we're at the point where
you want to be that person that gets a free home from the government. I'll be that person. Fuck it. I'll take a free home.
Generations are angry enough that and also they've backed themselves into a corner of what they possibly can't, because there is nobody that can come in and save this with all the dynamics as they are right now. Your Blackstone cannot get cheap funds anymore to go out and buy
Blackstone, institutional investors. We've hit the come trifecta. I'm coming.
These homes so that they cash flow, because the insurance and taxes are too high. And so they're really out of options, but they'll probably get more involved. They'll probably buy these up and start becoming sellers of homes. But that's not going to change the demographics. And, and ultimately this current administration did put guardrails on that crazy FHA program. And that's going to make a huge difference in the market.
I think she's talking about the FHA loss mitigation / house protection.
To the point that we're going to start to see foreclosures again, and we're already starting to see them. So I honestly lay in bed every night thinking about how they could intervene to keep this from happening. And I don't believe they have any options to do it. And printing money won't work, because that just means prices go up. And so we've heard, right? Yeah. Our top 10% is responsible for 50% of consumption. We've heard that number. If our top 10%.
Wait, is that true? When they say, what are we counting consumption as? Top 10%, 50% of consumption, like of all spending or whatever? I could believe that. I could believe that. I guess it depends on what she's talking about.
Could save the housing market. Consumption prices go up. And so we've heard, right? Yeah. Our top 10% is responsible for 50% of consumption. We've heard that number. If our top 10% could save the housing market.
Oh no.
This cheap motherfucker didn't even buy Zoom.
Oh no. Oh no.
I'm tired of waiting to debate you on why the housing market is fucked and the solution to fix it. Guts Original 83. You're obviously scared, so I'm going back to looking in chat. Wait, no, listen, join disagreements and I'll talk to you in a little bit. Hold on. Let me just finish this, okay?
Oh, right at the key part.
Here I am.
Melody, I'm so sorry. I have the free version of Zoom and it put a time limit on me. That's what
I figured happened. No problem. Okay, no problem.
Pull it back up. Okay. I'm sorry. It was right at a good point too. I
know. Oh, we were talking about government intervention.
Yes.
Oh, so if the top 10% could save the housing market.
Yes.
Why haven't they done it? I mean, we had the lowest sales last year we've seen since 1995, and we've increased population by 20%. And we now know illegal immigrants were participating at the tune of 6%. So if they could save it, why haven't they done it? I mean, we had the lowest sales last year we've seen since 1995, and we've increased population by 20%. And we now know illegal immigrants were participating at the tune of 6%. So
is she saying illegal immigrants bought 6% of the housing stock last year? Can an illegal immigrant would you even have that number on paper? I'm trying to think. Do you have to give a social security number to buy a house? You have to do a credit report. Did I give a social security number to buy a house? You have to have credit. You have to have an identity. They would have to be working on stolen identities, right? Well, oh, in cash only? Oh, I guess if you didn't get a loan. Oh, these are mega wealthy illegals. The ones who are stealing all the jobs.
If they could save it, why haven't they? Because they still have to rent to you and me.
Right.
And if we can't pay those rents, then what? We've increased population by 20%. And we now know illegal immigrants were participating in 1995. And we've increased population by 20%. And
what was our population in 1995? Population, 1995. I don't know why I Googled this. I should have looked at the thing. 260 million. Damn, we have got a lot of people really quickly. Damn. We're at 340 million now, almost. Show me the graph. What? USA population. Show me the thing. Oh, fuck you, Google. 344 million. Look at that beautiful line.
we now know illegal immigrants were participating at the tune of 6%. So if they could save it, why haven't they? Because they still have to rent to you and me.
Right.
And if we can't pay those rents, then what,
there's nowhere else.
That feel and all the illegal immigrant homeowner investors.
Like, yeah.
They're not gonna do, and that's why you can see luxury sitting all over the country. Like it is sitting. There's nobody to buy this because in 21 everybody thought we were getting rich. That wasn't true. It was very
Did you see Matt Iglesias get roasted by the entirety of lefty Twitter for not supporting price controls on stadium beers? Nope.
temporary, and wages stagnated again. And so all these builders built for luxury, built like spec homes for $13 million. It's crazy town. My point is, why would you,
Wow, Jay Sewell, thanks for giving 2 tier 1 subs.
as a rich person, carry an asset that makes no money, is an albatross around your neck that you don't live in, and maybe you go and rebuild like spec homes for $13 million? It's crazy town. My point is, why would you, as a rich person, carry an asset that makes no money, is an albatross around your neck that you don't live in, and maybe you go once a year? You're not going to do that and stay rich. That's how you get poor. And so they can't save the housing market. The institutional investors can't save the housing market. The government likely, like I say, will come in and probably take those off of people's balance sheets in one form or another. Maybe they give them a lending facility like they did with SVB and say, yeah, we're going to say it's 100%. We know it's really 25%, but you can, we'll fund it for you while you get back on your feet.
Sure.
But my point is, there are no options left. And unless the robots need houses, and right now they can't even give away Halloween candy successfully, we are facing headwinds that we just can't get around right now, especially when we realize that most of our population increase was immigration last year.
Sure.
And that's, of course, not happening at the scale it was. So,
I mean, I do see, if you go on like some of these subreddits where people trying to talk about selling their house, they're all desperate. They're all like,
oh, yeah.
Some of them are underwater on their mortgage and they can't cut the price anymore and they don't know how to. So it is.
I was at a conference 3 weeks ago where all they were talking about were short sales. Like it's exploded overnight. And a short sales where you go to the bank, please, please, please let me out. You have to take less money than what I owe you, but can you please let me out? Like that's a short sale. And so that's exploding right now. And the fact,
exploding where? Where? Show me this in the data.
Until we get increased sales, we're not going to see these price declines. That's when NAR's going to have to admit what's happening. But right now you have the top 1 to 10% participating, buying up the higher price homes. And you did have FHA, which was propping up a higher price home than it should because it was giving all these compensating factors to lower income borrowers. But that you can see credit restricting across the system right now. And so as that happens, that's when we're going to start to get true price discovery. Because if you can't refinance, you can't get a loan modification because you are so underwater and you can't sell, then distress. And I'm seeing it already. That's when you go into foreclosure.
So is this happening like now, now into 26?
Yeah. Foreclosure starts are up double digits year over year, as are sales. And you only need one of these in a neighborhood to impact your comparables, which means that as these increase, which we know that they are going to because of the distress, because of the layoffs, because this program has guardrails on it now in FHA, that is going to put a lot of pressure on prices. And I would say by Q2 2026, we're going to have a material foreclosure population. Even now in the 85 cities I track, I can see them all over in every single city.
In your estimation, and nobody knows the answer to this, so I'm just trying to get a general sense of how big you see this is. There's a lot of contagion here because we're seeing the same type of thing in auto. We're seeing it in commercial real estate. We're seeing it. I mean, people are defaulting on their student loans at record high. There's defaults in almost every aspect of debt. And so I personally thought housing was one where we were going to see less of it. But what you're telling me is that it's just as bad, if not worse.
And it's so much bigger pie of the debt. So much bigger pie. The Fed came out with a household debt and credit report today. And you get to see the bars of here's student loans, here's auto, and the mortgage is like, So I call it the big orange because on that Fed schedule, it's orange. And I say when the big orange.
Okay.
Orange gets in trouble, we're all going to be in trouble. And it's kind of funny. It's orange man, anyway, but that's it. It is really bad, but also then job loss. And we are definitely seeing white collar get, I mean, these just decimated with these layoffs announcements. And I don't think it's going to stop. And it has nothing, in my opinion, to do with AI. And
to be clear, her prescription is that there will be a market correction because of the speculation on housing from individual investors from the past few years. I mean, there's always like mini corrections there. This sounds like the kind of lady who like predicts bubbles for like decades, and then when a bubble finally happens, she goes, "I'm a genius." That's what it sounds like. I don't know how relevant this is or what argument is being made with this, but like, I don't even know if this is necessarily like a bad thing. Or like, imagine if we added some zeros here, and imagine we like talked to our friends about this, right? We were like, "Oh my God, the mortgage debt is like so much debt here compared to everything else." Like, well, yeah, but I mean, like, it's also backed up by more real asset. It's a secured thing. Imagine your friend tells you, "Oh, I have a mortgage for $137,000 on like a, $150,000. It's like, oh, okay, fine. $137,000 mortgage, sure. But then imagine that same friend tells you like, I also have $11,000 in like a home equity line of credit. It's like, okay. And then imagine I still have $15K in student loan debt. And it's like, that's not too bad. $15K, how depending on how old you are. Then let's say your friend says, I have $24,000 in credit card debt. You're like, what? $24,000 in credit card debt? I feel like even though it's a smaller number here, but I'm also super poisoned against credit card debt because of my fucking family. I feel like credit card debt is this is bad debt. This is bad debt.
We're all going to be in trouble. It's really bad, but also then job loss. And we are definitely seeing white collar get, I mean, these just decimated with these layoffs announcements. And I don't think it's going to stop. And it has nothing, in my opinion, to do with AI. And
you're scaring us, Melody.
I know. I'm sorry.
No, don't apologize.
I changed my, like 3 years ago, I changed my life completely because I could see this coming, and it was just math. You just looked at the math, if your median household, because I could see this. I'm sorry.
No, don't apologize.
I changed my, like 3 years ago, I changed my life completely because I could see this coming, and it
changed my life completely. How?
It was just math. You just looked at the math, if your median household can't afford the median price of a home,
something will eventually correct. Like there's
And it's like, and we can't all go on vacation like we did with revenge travel, after COVID. Tourism is down. Like Las Vegas right now is getting pummeled. I mean, if you took a little trip out there, it would terrify you. Absolutely terrify you.
Okay. Listen, I think that is the key thing.
That's a big Reddit meme, but I'm pretty, I don't know. I've been to Vegas. Was it a month or two ago? I feel like I was in Vegas relatively recent. There are a lot of people out there. I mean, all tourism is down in the United States, though. I think we're majorly getting fucked, though, by, I think, Canada and maybe Mexico. I think Canada was a big one, but our international tourism is down, I think, quite a bit, like numbers wise. I don't know about intrastate or interstate from state to state, but
I wanted to talk about anyway, and we got to our main point. I do have one small question for me personally, which is about, you mentioned property taxes, and I want to hear your thoughts on this because in some of these areas, I think like Florida and others, Texas maybe, they're like politically becoming unpopular, even though they're the only way the state is funded. And so they're like imploding these property taxes, which is like the last tax that the boomers who have the wealth in the area are paying. It feels ridiculous, but I want to know, am I missing something? Or like, what is this part of this constant like government assistance to keep things?
Yes.
Okay.
Wait, let me just make sure I'm still Chicago, IGM, Forum, property. They still like property taxes, right? This is a thing that, fuck. What's the site that has all the economists surveyed? Property taxes, we like property taxes, right? Unless I don't think I've given, I think property taxes are good. You have a big ass fucking house, pay some goddamn fucking tax on it. Big taxes too, fuck them, big. I love property taxes. States that get rid of property taxes are fucking retarded, okay? That's a real good ass fucking tax.
So through the American Rescue Act, like something like $350 billion went out to the cities and state. I mean, which is why you got so many down payment assistance programs, and why I thought like the Harris $25,000 down payment. Yeah, you could already get that in every city across the country, like through one of these programs, because the American Rescue Act went out and you could create these like home affordable programs, things like that. But all of these cities thought they were getting rich forever. Like this is the mentality. And so they spent like drunken sailors. Nashville, 100 people are moving here every day. Number one, that was never true. Number two, a lot of that was temporary, but they would do these calculations like if 100 people are moving here, then I'm going to get X amount of property taxes. And so they would calculate, number one, that a whole bunch of people are going to move there.
This is the city governments?
The city governments. And that number two, that home prices would continue to go up because that's what everybody believed. And so in their little, funny math minds, they were going to be rich forever. And so they spent like that. But now you can.
This is a hyper minutia point. Somebody's going to have to correct me if I'm wrong. I can't be right here because she would have to be really wrong. Property values increasing doesn't actually impact your property taxes much, right? Because doesn't the county assessor, when they're calculating the value of your property for the sake of property taxes, doesn't that stay more or less close to what you bought it for until a property is bought or sold? Or was that just from my house in Nebraska? Or was that, so like for instance, if you have a property, I think I just used my, as an example, I think I bought, was my house 150K? I think I bought it for like I'm not gonna remember this. Like if you buy a house for 150K, let's say that like 15 years later, let's say that you could sell that 150K house for 300K, even if you could probably sell it for 300K, and that's like what the going rate is for equivalent homes in your neighborhood, the county assessor will still have your house like assessed at like 170K because because of the way the county assessors do their math. Is that ordinary and normal, or was that just Nebraska? Or yes, I believe it adjusts for inflation, so it goes up every year, but it isn't the actual selling price you can sell for now. Yeah, okay. I don't think it's always jumping to match property taxes by state in the U.S. I don't think it's always jumping to max with the actual sell prices or the actual value of your home is at a point in time. Douglas County, also some of the highest property tax rates in the state. It's 2% and change. Okay, that's my house.
can go to all of these cities and they are bankrupt. I mean, they are in budget deficits.
Yeah.
The Chicago bonds are like got kicked out of their muni fund. Like, and there is going to be a limit to what they can actually do. I mean, there's just going to be a limit.
Yeah,
I'm sorry.
No. I don't be sorry. I really appreciate you laying this out, and I think this is what a lot of people want and need to hear. But I want to end on hopefully not a happier note, but
it's a happier note.
An interesting one. I want to hear if you have any advice, because the people we're talking to right now are probably 18 to 32 in that range. They aren't, or maybe just started on the housing. They're trying to figure out what to do with housing. What is your advice for them financially, and do you see signs of life for them in the field? Like, where's your head at for that?
Yeah, I'm going to sound like their grandmother right now, but it's important. It's really important because I made all these mistakes when I was their age. I had no financial education. I signed up for student loans. Like, I'll be able to pay that. No problem. You know, my credit card was at the same little booth at my first day of college as the student loans. You just went from there to there. And I did a whole bunch of really stupid things. So I'm not the kind of person sitting there that hasn't done all these stupid things. I'm talking from experience, but say no to the labubu. Like, say no to the FOMO and the YOLO. Like, you only live once. That's right. Do you want to be destitute? Firstly, get a financial education. You know, seek somebody out like myself or others who are not just trying to make a buck off you. Like, if you sign up for my Substack, for instance, the free version always has the whole argument laid out.
Yeah, I will say, for people watching, her Substack is truly incredible. It is a great way to keep up with what's going on in America's housing market and broader financial situation. It's pretty fascinating. So I'll link it in the video description. Yeah.
Oh, thanks. Yeah. But they can get a lot of it for free, you know? Okay. So get a financial education. Say no to debt. Say no to buy now, pay later. It does matter. And also I think one of the things I used to believe is like, of course, my paycheck's just going to keep going up and up and up. I'm a capable person. I work hard. I'm never going to be laid off. Well, that's just not the reality. Once you get to a certain age, you become a liability to a company and you will be the first out the door, no matter how productive you are. So
does she advocate never borrowing for anything ever, or?
My point, don't bank on always having.
I mean, even if you're not, even age out of it, it feels like this is a time where you could be talented and great, and the broader winds of the economy can hit you.
I think that, also I would say this is a big one for when we go into downturn is, keep learning, get new skills, teach yourself things so that you can
grind set.
Quickly sort of change direction if you have to, if you lose your job, things like that. So say no to debt, save, get a financial education, and get more skills.
And if you do these things, if you do feel like you've gotten yourself on some sort of stable ground, you're saying that you think the people that have gambled incorrectly on the housing are going to lose money on it, and it is going to get cheaper, and there is going to be ability to get a house. Is that
absolutely?
All right.
Absolutely. Yeah, well, and that is the good news.
Melody, thank you so much for your time. I really appreciate you coming on.
No,
thank you so much as more of this unravels.
Oh, absolutely. Anytime. Thank you so much.
Have a good rest of your day.
You too. Bye.
That was great. A little spooky. She didn't pull any punches, but I really appreciated that. I will link her Substack as we make a clip of that. I know some of it, especially at the beginning, is a little in the weeds, and that's an interview thing for me. I gotta make sure to start broad so everyone can follow along.
I grab a Red Bull and I'll chat with this guy in Discord. Hold on one sec.
And then get into more detailed stuff. I often flip it, and I can't overstate enough how much she does the actual work. That's why I'm always looking for Substacks and people who are experts in their field. She's one of the best ones I've ever found because she actually drives out to these damn places, talks to the developers, talks to the buyers, talks to the sellers, talks to NAR, like understands the level of fraud and deception and reality going on in these part of these markets. I'm in the Dallas housing market. It's so crazy right now. I mean, I've been aware that Florida and Texas are horrible. They drastically, like, if you just look on Zillow in those areas, there's everything is for sale and it's all getting price cuts all the time. Nobody can afford the prices that they're at there. They're going to crash for sure. But she's telling me that it's broader than that. Do you agree when she says housing supply is a real problem? I think I fully agree with her on the market she's talking about. We didn't really get specifics. I still think like parts of cities that still have inflow, obviously there's still a supply issue, 100%. On a broad scale, it does track that there was insane amounts of building of people that thought they could build it, flip it, Airbnb it. I work in commercial real estate lending, and it's crazy watching everyone at the bank here adjusting internal covenants to prolong issues not to call them. This is what I'm talking about. That's why I got to make the video with Bill Moreland. This is the core of it, is that so many loans have been given out rather than admit that they can't be paid back. They are just doing so many complicated ways to pretend and make it look on the books like the loan is still being paid. Even people that have big buy now, pay later debt. If you call into Klarna or Affirm, they're giving you options to like extend and pretend like you can pay it back. If they have to write you off on their books that you are a lost cause, that you are a defaulted loan, that impacts them. So everyone is trying to like just hold and hope everything gets back to everyone can afford their loans. Where the correction happened in housing, where does that money go? Is that paper wealth lost? Yeah. It's a great question. I want to try and explain how this works. So let's say it's a neighborhood, right? You have one of these houses. You bought it for $750,000. Wow, look at you. $750K. So you feel like you have a $750K asset. This is money that you feel like is part of your wealth. You're the last person to buy in this neighborhood, which means based on comps, the average housing price here is $750K. Like the last sold house in the neighborhood sort of sets the price. So everybody feels like they have a ton of money. If one person cracks and sells as prices fall, as there is no demand, this person has to move. This person has a divorce. This person has to sell. And they sell for $450K. Let's go red, $450K. Okay? This person sells. Now that's the new last comp. Now all of a sudden these are marked down. You look at your housing price, you're underwater. If you bought late, you're underwater. Everybody, you've all lost this money, but that's not, it just disappeared. It's like,
well, it's not, I don't think it's usually that dramatic. Also, that's an insanely small, or that would be a huge decrease in price to go from 750 to 450.
housing price, you're underwater. If you bought late, you're underwater. Everybody, you've all lost this money, but that's not, it just disappeared. It's like the collapse of the wealth effect. It doesn't go to anyone. That's the idea. And then once you're underwater, once you have a $450K house, but you're paying like a $700K mortgage, a lot of people abandon their, like this is what happens in the GFC. People start stopping their payments. They stop paying.
No, I don't believe this. No, hold on. Something is happening here with Atriox Brain, because he normally is really going to find himself. Nobody abandons their house. First of all, I don't even know if you're what would it, maybe for the county assessor? My assessments must have been different because I feel like my assessment was never at the actual sell or market rate for my house. But like, nobody's just saying like, oh shit, I'm slightly upside down on my mortgage, I'm abandoning my home. What? No, nobody, this is not a real human behavior. Now, around the financial crash, maybe, but that's because people were sitting on adjustable rate mortgages for shit that they couldn't afford, with the idea that things would change in the future, with the idea that they would upgrade their house sometime down the road. There were people that never should have been in those houses. That was a very unstable market where people were pricing in a whole bunch of upward trajectory. And then when that corrected, then shit got fucked. But the idea that somebody's like, oh, I just bought my new house. Oh my God, the price of the house, I'm upside down on it. Time to abandon my shit and ruin my credit for the next 7 years. No, that's no bullshit.
They default, they leave the house, which causes more sales, which causes prices to go down. It's a reverse doom loop. Again, if you don't own a house, while this is scary and not good for the economy, I do agree with her, but it's like, there's going to be opportunities for, I think,
this is also, keep in mind, nobody talks about for some reason, when people will switch brains when they talk about things and they never consider that they're talking about countervailing forces. Everything that you're talking about here, when he just described, let's assume that the situation that he talked about here was a reality situation, right? The guy sells for $50K, all this stuff. That's good for your audience. Your audience technically likes all of that. Like, oh, wait, you're telling me I just got a $300,000 discount on every house in this neighborhood? That means rents are going to fall. If I want to buy a home, then the cost for that is going to be severely lower or significantly lower. Like, technically, that's a good thing.
They stop paying, they default, they leave the house, which causes more sales, which causes prices to go down. It's a reverse doom loop. Again, if you don't own a house, while this is scary and not good for the economy, I do agree with her, but it's like, there's going to be opportunities for, I think, good houses at more realistic prices. But who's selling? Everyone. They're all trying to sell, bro. Everyone's trying to get out. Just look at the share of homes with price cuts. Dude, massive spikes in Florida, in Texas, but it's spiking up all over the country. But they haven't cut it enough yet. People still don't want to buy. The number of people backing out of home sales is at all-time highs. Panic is starting to spread among not only the bigger housing investors that bought up a ton of stock. She mentioned they're net sellers, but the Airbnb people, people that moved to a different state, people that bought second homes. All these people are realizing like, oh, fuck, I can't afford the mortgage on this. I can't rent it out the way I thought I would. Do mortgage rates not follow Fed cuts at all? It's a great question. Normally, there's a connection. But what's been happening lately, I mean, what they really follow is the US 10-year, okay? This is what mortgage rates usually follow. And this is not what Jerome Powell can cut. This is just based on people buying and selling US debts, the bond market, people that believe or don't believe in the US IOUs. Despite the fact that they keep cutting the short-term interest rate, the 10-year remains stubborn. And so interest rates for mortgages are not going down. People's payments are still high. And what this reflects is like investors, other countries, the world, not believing or just requiring, not believing in the promises of the United States' debt. It's like the simple way to put it. Like they require a bigger interest rate to loan money to the United States. I live in Austin. I consistently see huge price cuts for homes that were much more expensive a year ago. I'm super tempted to get something to the deals I'm seeing. Should I wait that longer? Again, I can't tell you specifics. I don't know. I don't think Melody knows either, but I think based on that conversation, she would tell you at least wait till Q2 26. That's what she would tell you. Because it seems like they're in a process of true hitting the wall. She did call her shot. I do think it's fair to say, like, if you're gonna live in a place for 10 years plus, at the end of the day, fuck it, like, whatever, you'll ride it out, you want to live, but it is the biggest financial purchase of your life. And I do think prices are materially too high right now. They're not real. I couldn't get my graphs to show correctly, and then she didn't get to show her graphs, but I'm gonna show them anyway. Fuck it. The typical US renter is older than they've ever been. 70% of the US renter population is age 30 or older, an all-time high. And that is because young people are just living with parents more. So not only, normally around your—
Fuck, I hate that other graph, that it doesn't show young people who don't have kids. Percentage of U.S. renter population age 30 plus. Okay.
Your 30s, you'd be able to buy a house. But the age of first-time home buyers has hit 40.
Okay. Things are fucked for since COVID. This is true. Things have been really weird since COVID.
Which is absolutely fucking insane. First-time home buyer at 40. We are just denying people the normal markers of life that they've been promised. Around your 20s and 30s where you can get a home, start a family. We are just pushing that out.
Like, just think, I'm sorry. I know, listen, I love you, my Americans, okay, but like, just think about what he's saying. The promise of life in the 20s after college, you will buy a house. That's that's just...
So literally...
We can do it, but you're gonna have to make other sacrifices.
40, which is like late career, bro. That's crazy. No wonder people are fucking pissed. Oh, perfect graph too. So I want to kick off here. Look, in 20, 21, 22. If the yellow line is above the blue line, that means there's more buyers than sellers. This is what people were thinking of when times were fucking good. When housing prices were rocketing up. There was so...
Times are good for who, though? Because this is probably when you're putting the most upward pressure on rents and housing prices, right?
Many fucking buyers. It was a seller's market, dude. They could raise the price every damn week. They could be very picky. There was lines out the door for every open house. Now they slowed down in 23 and 24. Basically no transactions. And now we're seeing rising sellers.
That's good for you, though, if you're buying, right?
More and more sellers. Desperate sellers. They can't find a buyer. They have to keep cutting the prices. And I think this is what Melody's talking about. This is only going to go up. I think the most interesting thing from our conversation is that it's not just the riskiest borrowers. I like this graph, too. It's my last graph. This is serious delinquency, 90 days plus on student loans by age. Recently, this year, we talked about it. You have to pay student loans again. It's fucking skyrocketed. I'm sure a lot of you...
Dog, come on. Hello. It's in front of you. Come on. Wait, hello.
90 days plus on student loans by age. Recently, this year, we talked about it. You have to pay student loans again. It's fucking skyrocketed. I'm sure a lot of you are not paying your student loans. Just based on the math. A lot of you have student loans and you're just saying, fuck it, I'm not paying. Anyway, at least our government's functioning tip-top shape. So whatever challenges may come, we've got the best and the brightest on the case. And the government is open for business and they're working together in a bipartisan way to solve our problems. So at the very least...
Okay. That was what a wild ride.